back in San Francisco, Dylan Radigan in Milan. So we take you through the rest of this trading day. Futures market closes at 5 Eastern, 4 Central. If you're on the platform on the website, tastylive.com, thanks for joining us. Come over to YouTube. Tell us what you're trading, what you think of this market action. We can head right over to the charts here as we start the show off, as we get an insight into Tesla's earnings here. Currently trading right around where it closed, $238 and change or so. EPS estimate was 42 cents, comes in at 27 cents. That's a miss of 36%. Revenues were estimated at $21.4 billion, coming in at $19.335 billion. That's a miss of 10%. EPS is down 40% year over year. The revenues are down 9% year over year. The EPS is down 63% quarter over quarter, and the revenues are down 25% quarter over quarter. And yet, Dylan, the stock is trading where it was about 3:30 Eastern today. Is this just a case of finding out yesterday's news? We knew Tesla was going to have a bad set of earnings in Q1. Is this worse than you expected?
I don't think that my expectations matter. I think that you hit the nail on the head, which is that you kind of couldn't have a more disappointing or abysmal financial performance from a publicly traded organization, at least if you measure by the speed of the acceleration or decline in sales and earnings and every relevant financial metric. It's an unusual and extreme disappointment or decline in all the relevant numbers. But it sort of, if anything, it proves the market as a discounting mechanism. Because the stock, imagine if the stock was at its peaks and a financial report like this came out, it would be a mess. But I think that it's yesterday's news.
Yesterday's news, perhaps, looking through their financial summary here, automotive revenues are down 20% year over year, gross profits down 15% year over year. Income from operations is down 66% year over year. Adjusted EBITDA is down 17% year over year. Non-GAAP income minus 39% year over year.
And where's the stock right now? Is that up 4%?
Yeah, it's still holding on to its gains from today. We close in at 237.97 today. We're currently in at 239. But Ellie, I mean, this is a game of expectations. We've seen we were talking in the green room here. Who on earth was expecting Tesla to have a good quarter?
Nobody. I mean, the price action here is really, I think, indicative. We were just talking both in the green room and on last call, and my thoughts were that nobody cares about this report, and it's because of the expectations. They were there at 41 cents a share, which obviously we've shockingly missed, but 41 cents a share would have been a 44% almost decline relative to the 73 cents a share we got in the previous report. That was the forecast. So we were looking already for a blistering downshift in Tesla earnings as consensus. And obviously 27 cents a share is worse than 41.
Can I just provide some additional color here as some comments are coming out as I'm finding them? They note that they are leaving out a return to growth forecast from their earnings report. They're going to revisit their 2025 guidance in their Q2 update. They say that it's difficult to measure impact of global trade policy on their company's earnings, and the uncertainty could impact demand for Teslas in the near term. So you're seeing, in some sort of guidance here. It's interesting, Dylan, how Tesla's going to thread the needle on this commentary, though, right? Because anything that Tesla says is effectively an extension of Musk saying it.
Well, yeah, I think another reason.
Well, I mean, go ahead, Dylan.
I was just saying, if you ever wanted to know the value of Elon Musk, it's obvious that Tesla's stock price at this moment in history is not trading based on financial performance of the underlying business.
Moreover, we know that Elon Musk has been yelling at people like Peter Navarro about the trade war and saying it's a bananas way of proceeding from his perspective. And we see in these results his company very clearly suffering from exactly the kind of tariff policy uncertainty that shows up in the PMIs that everybody else is worried about.
And why won't the other car companies, by the way, see big declines in their performance as a result of a massive implied increase in their either supply chain operations and or their retail distribution price points? Full stop for every car company.
If Tesla's going to complain about supply chain issues and impact of tariffs, then every other company is going to have it worse. If only because Tesla has done a good job.
And to what degree is this quarter of Tesla's financial performance a reflection of political sentiment, and to what degree is it a function of foreshadowing of precipitous declines in demand, full stop, especially for large expenditures like cars?
Well, Tesla's done a good job standing up supply chains in local markets, so if there's a global disruption, it's not too terrible for their bottom line compared to other manufacturers. But nonetheless, I mean,
I think they're the best.
They might be the best, which is so ironic that as the Trump administration tries to press forward with, reorienting American domestic manufacturing policy, this is like the single area that Musk has expertise in, and that he's probably done better than anyone else in America in the modern era.
And organizing resources to do any big idea, he's the best in the history of the world.
And yet he's completely sidelined in this entire conversation. He's talking more about impeaching judges, right, than he is talking about manufacturing, which is like the guy's done it better than anyone else in the modern era in terms of that. But
100%.
Okay, it's
but you're trying to use logic against an illogical structure, which you already know this.
Well, it's like he throws a 100-mile-per-hour fastball, so we have him, sitting on the bench. It's like, no, get him out there, put him on the mound. This is what he knows.
But you're assuming that there's some you're assuming you're not dealing with an impulsive and fickle, non-logical system, which is American politics.
That is true. So listen, the commentary here from Tesla isn't surprising. I think if there's anything surprising here, it's just things are really, really bad right now for the company. We do have an earnings report, call that's going to be coming up shortly as well. Musk will be speaking on it. That's something to chew on. Ultimately, stocks here, which were bouncing up into the end of the session, do get a little bit of a pullback. The NASDAQ here up by 2.46%. And what a maddening day it was. Stocks ultimately higher by 2.5% or so across the board. On the back of a rumor this morning, CNBC reports around 11:55 Eastern Time that Treasury Secretary Bessent gives remarks at a private event, JP Morgan private event. No media, no public. But he gives these remarks at a private event suggesting that there's going to be de-escalation soon. CNBC's own Eamon Javers provided more clarity later today around 1:23 Eastern about the comments that Scott Bessent made. And this is a rough transcript in his words. Quote, the next steps with China are, no one thinks the current status quo is sustainable at 145 and 125%. So I would posit that over the very near future, there will be a de-escalation. And I think that should go, given the world, the market's a sigh of relief. We have an embargo now on both sides, right? Dylan, this doesn't sound like there's a de-escalation happening. It doesn't sound like negotiations are occurring. It sounds like this is another one of the...
No, but again, you're dealing with a market, as I've talked about a bunch, and I'm not the only one. I mean, it doesn't matter for me. It's a mathematically observable that the market does not believe that what is being discussed in public is likely to be what is implemented in reality, particularly when it comes to numbers like those with China. And what you're getting from sort of this back talk from the Treasury Secretary is an acknowledgement of something that the market is deemed to be obvious.
Oh, yeah, you seem to be a little bit more skeptical about today. Liquidity comes back into the market. We get a rally. We get some news to chew on here. It sounded like today you were using the opportunity to potentially carve out a little bit of a short delta position in stocks.
Indeed, that's exactly what I did, because what this looks to me like is exactly the thing we talked about yesterday. So we said, stock markets are back to selling again, but liquidity is really thin. And we're still going to have the reopening of markets around Europe, around some of the big parts of Asia, obviously sans Japan, which opened on schedule on Monday. I suppose you could say China is a solid-sized market now. That was open, but Hong Kong was closed, Australia was closed, all of Europe pretty much was closed, wherever there's a decent pocket of liquidity. So there was going to be something that was going to happen tactically as that liquidity came back and kind of found that the U.S. had driven things to lower lows relative to last week's close when we came online. There was likely to be some kind of a tactical reshuffling around that, some sort of bottom fishing likely. And so we get a nice little bit of news to go with that. And the bit of news is as flimsy as the 90-day pause on the reciprocal tariffs over 10%. And the rally is shallower. We said when that pause came, well, if the reason the tariffs are spooking people is uncertainty, not the sort of conceptual architecture that there will be tariffs, but that there is uncertainty about the rollout and that it's chaotic and difficult to predict, and that's hitting business confidence and consumer confidence and having a cyclical impact. And that's the reason for stocks to be concerned and for markets in general to be concerned. The reciprocal tariff news was window dressing at best. Oh, goody. Tariffs only went up 5 times from an average of 2% to an average of 10%. They didn't go up more. Oh, and by the way, now we have a new deadline that's 90 days away. Don't anybody go make any kind of business plans, because in 90 days the whole thing might change. There's a new season finale on the books. You got to watch it. Don't do anything. That's more uncertainty. So it was, as we said then, pretty obvious that if the uncertainty is the problem, the reprieve is meaningless. And if the reprieve is meaningless, the rally that it ostensibly sparked is to be sold, which is precisely what I was doing. And to me, this is exactly the same thing. Liquidity returned. It gave us a little lift. The news is ultimately fixing of nothing. And look at the NASDAQ. The backfill, I think, on NQ futures is probably the most telling. And Brent oil is another good example. So is crude, but WTI crude. But take a look at a 4-hour chart of this and of NASDAQ, and what you see is a break of the preceding range, a bounce to test its underside, and a hold right there. So to me, this was a nice opportunity to sell at higher levels than we closed yesterday. Obviously, I'm using verticals and keeping it risk controlled because these are very jumpy markets and ultimately who knows. But this looks to me like the spot this week where maybe you had a chance to take a bite of the bearish apple if you didn't get in on the aggression that was yesterday. And maybe now we head lower from here.
The news flow today, to me, was so funny because we hear that Besson says that, the situation's untenable, and there was separate reporting that said Besson acknowledged that negotiations with China had not begun yet. And then about an hour later, during her press conference, the White House press secretary said that negotiations with China had begun in that interim window. Just very difficult to believe. And the market ultimately sold off around those comments from the press secretary because do we really think?
But isn't the biggest nugget of information that whatever exists, whatever is the existing rhetorical agreement of this moment, will not be. It's not that Besant is right. It's that whatever exists now is not what's going to be. And the big debate is how much of an economic slowdown is there going to be as a result of all of this? And how soon is it going to be? How deep is it going to be? How severe is it going to be? And how much circumvention of it will there be?
Exactly.
Well,
I mean,
whatever it is,
again, this is not about the concept of tariffs.
But what's on the news from the president is not what's going to be.
Or at the very least, you cannot take it at face value, even for a 48-hour window.
I'm happy
if we are all Pavlovian dogs, this is what we have been taught.
And what did exist will never exist, but will exist is still a subject of great debate. Which is why
the one thing we know will exist is some sort of economic downturn.
100%,
because if you look at the break evens in the bond market, you look at what Fed funds futures are telling you, they're gearing up for recession.
Exactly.
So, trade deal, no trade deal, yeah, whatever. Okay.
I think the charts say enough. I mean, we're funneling in both ES and NQ into triangles right now. No matter how you slice it, right? Which are springs that are coiling and suggesting that a bigger move directionally is coming. It is top left to bottom right. So continuation wise, one would surmise that this is going to be another attempt at the downside, perhaps in the short term, at least just on a pure technician's basis. There is one thing that stands out today, however, amongst all the noise. You do have stocks bouncing. You do have bonds bouncing back, particularly at the long end of the curve. Gold prices put in quite the nasty session. GLD looks a little bit worse than gold futures. Gold, you can see GLD here is looking a little bit more like a top. And for the first time in GLD, you get a close below the 1 week moving average.
And a vicious evening start.
Oh, let's just go back here. That's that 1 day moving average, excuse me. So this is the first, you have this daily key reversal here on the 12 hours, the evening star candlestick cluster. But something happened today in gold. I myself, as talked about at Futures Power Hour, I got out of my long position. No longer long gold. And I likewise flipped short. Flip short today as well. Why is this the case? Something triggered today at the highs where gold prices were more than 25% above their 200-day moving average. That is a unique occurrence. It hasn't happened all that often. Happened 12 times before. When we think about the propensity of what gold does over the next week, next month, the returns are negative most of the time. At least a week later, it's about 70% of the time. A month out, it's around 56%. And losses in the neighborhood of 2% or so. This has been a tremendous run. But if we have an unwind and unclenching in these markets, gold has been the primary beneficiary. And I would think then, if we're going to a risk-on mode with hope and deals potentially coming, despite whatever rumors there are, the asset allocation shift becomes pro-silver, pro-Bitcoin, and less pro-gold moving forward, as there's a little bit of a catch-up window. But again, the historical nature of the rally just brought us to a place where gold has typically seen exhaustion. If history is any sort of guide, and who knows if it is. But I decided to flip from long today to short once we started to see that we got into that rarefied atmosphere. That the last time we did on an intraday basis was in 2020, March 2020. And then before then was August 2011. And those were relative, peaks for
huge turning
gold
points.
Prices. Huge turning points for gold market and turning points in which silver superseded gold.
Yeah.
So I have made my adjustments right now in the safe haven aspect. And then Bitcoin up 4.5% today, back above 92,000. So even yesterday when it was seen as a safe haven with gold up and the dollar down, Bitcoin in a risk-on market is now getting a bigger kick. There's a lot of asymmetry, it feels like here, Dylan. Almost as bad as yesterday, gold and Bitcoin up, all the dollars down.
I know, you hate it. You hate it. I mean, it's just one of the worst. I try to go into denial. Like when I hear about the strength of Bitcoin and gold and then the relative weakness, I mean, the dollar today could have been worse. I mean, it's been just the overall trend of whatever, since April 1st or whenever it is. To have dollar down, rates up in the face of a slowdown in a risk-off marketplace is troublesome.
Very.
I'm trying not to be hyperbolic, Ilya. I'm trying not to cause concern in the streets. I'm just saying it's troublesome and unusual.
I mean,
and unprecedented. And
I was writing about this today.
I don't know how you get
We
a
know about the
slowdown in
dollar-
a risk-off market, and then I get a dollar down, and I got a rates up, and I got Bitcoin up, and I got gold up. I gotta say, these are not good signals.
So Chris and I like to nerd out on the dollar smile model, which is something that was developed.
Learned it from you.
By the economist Stephen Jen, who basically put out the idea and showed the data backing for it, saying that the dollar tends to do well in times when the U.S. economy either vastly outperforms or vastly underperforms G7 peers. That essentially the dollar's performance is like a parabola relative to its growth performance, and hence the smile. And what this captures really is that if the world's largest economy is vastly underperforming, then there's probably risk aversion and a global recession and blah blah blah. And it tells you the dollar is a haven asset in times of extreme stress like that. It also tells you that if the U.S. economy is outperforming, well, then the classic currency market dynamics apply. Strong growth, higher inflation, central bank raises rates. Something with higher rates is more attractive as a yield instrument. People buy it. So the dollar either rises for classic currency reasons, higher yields, or it rises because risk aversion, because it's a haven of liquidity. Okay, what are we seeing here now since the beginning of April? We're seeing higher rates. It's not doing anything for the dollar. We're seeing risk aversion. It's not doing anything for the dollar. The architecture of everything that's defined the way the dollar works, basically since the 1970s, when Nixon abandoned the gold standard, isn't working. That's how far back this data goes. I've been able to reconstruct the dollar smile myself from scratch, going back to as far back as 1975. So
he's not smart. What do you call this shape? Where it's like goofy faced, where one side
this is regime change.
What is it? It's the scream face?
Regime change. This is regime change. This is structural regime change, and it's not good. I don't think it means.
I thought you'd switched from smiley face to scream face. The
line has just left the chart.
But it can't leave the chart because it's still the reserve currency. You know,
that's the whole thing.
Despite Bitcoin, despite gold, despite the
it's still the currency of commerce, and there's
no place else. You're in a prison of your own creation. If you're China,
there's no changing that.
If you're Europe, if you're London, if you're Rio, if you're Shanghai, if you're Beijing, if you're Tokyo, everybody's long the dollar. It's the only currency in the world that everybody has. Even the Russians by proxy in Dubai and Istanbul and all in Bangkok and all that.
Well, the liquidity is so great, there's no way around it because there's just no alternative. We'll see what the Europeans manage to cultivate now that they're happy to have fiscal mutualization, at least on defense. We'll see if this is like a gateway drug to a fiscal union. But what we are going to get probably for the next several years, because you're absolutely right, there is no alternative, is just a structurally weaker dollar. So any rallies are sold.
Awful. And no one knows the levels. It's going to be
great news for U.S. consumers who are going to lose purchasing power of imports and experience inflation.
But by the way,
of the practical kind,
raising the price of all imports could easily be a conscious decision of this White House.
Yes.
Obviously, it is a matter of policy, not just by way of tariff, but by way of a weaker dollar.
This could be the adoption of a weak dollar policy to rebalance.
How could it not be?
Trade. Whether it's a wise decision is a separate question.
That's part of Stephen Mirren's Mar-a-Lago talk. They've deliberately, the advisors close to President Trump have deliberately outlined a policy where they'd like to have a weaker currency. That's when part and parcel to the Mar-a-Lago Accord talk that you hear in some of the macro circles where people are in earnest trying to find some sort of policy framework to have this all make sense, to learn how to invest around it. The dollar today has a bounce back against the yen and the euro here, but not exactly, the most convincing thing. We're still below our 1 week average. The dollar is much, much weaker than interest rate differentials would suggest they'd be. It's obviously breaking free Bitcoin.
The most interesting because the dollar bounces against the Aussie probably more convincingly than against a lot of the other names, and it's on a risk-on day.
Well, and particularly where
so it just tells you
topping out.
You're through the looking glass here. This is a completely different kind of dollar.
It's your dashboard to global activity, full stop. Because really, anyway, we have to go through all why. I guess what's interesting to me, Ilya, because I could do this with you guys probably forever. It's like the most fascinating financial event of our lifetime at this point, right?
Yeah.
Yes.
Why are you so? And I don't want to assign sentiment to you that I don't know is there. Why are you still willing to get short? Why do you believe the market doesn't reflect the magnitude of the coming slowdown? How about that? If that's a fair presupposition in my question, I don't know.
So I am willing to get short because I think what the market is still not reflecting, for lack of evidence, is the actual economic hit of what is probably coming. Because first you get the economic hit, then you get the follow-on, which was always gathering, which is the credit element. This year marks the refinancing of everybody's 5-year COVID money. And that's a huge pile. Obviously, I've been talking since last year about this idea that this tightening cycle was unique in that in every other tightening cycle since the dollar got untethered from gold in the early 70s and the current financial system was born, saw companies pay more for interest when the Fed hikes. Of course, that's the point. This time, that didn't happen. They actually paid less. And it's because during COVID, they absolutely gorged on free money and just put it in the mattress and sat. Because there was nothing to spend. There was just very cheap money, but lockdowns and supply chain disruptions and all manner of reasons not to spend it. And so their cushion was very, very, very deep. But that money comes for rollover this year and next year at interest rates that are maybe, by the time they get around to it, 3 times higher, not 5 times higher, like they could be at the peak. And so on top of the loss of economic momentum, because people are afraid and there's uncertainty, which is what the PMIs are telling us, the consumer confidence numbers are telling us, that people are essentially holding back spending and saying, we don't know where the dust is going to settle, let's wait. And so things have hit a wall. Beyond that, there is then the actual damage to economic activity once the hitting of the wall commences. So things have stopped, but then the economic hit, that's still coming. And the pain, once it starts to reverberate through credit markets and amplify what was already going to be a stressful period, all of that means even more weakness. And the resolution is probably more Fed rate cuts once it shows up in the hard data, or at least once the PMIs tomorrow are sufficiently a trend-making event that Fed officials can start sounding dovish in comments going into the May meeting, whereupon they may actually start to cut, or at least signal it so strongly that by June it's a done deal. So all of this unclenches, but how? Weaker stocks, higher bonds, and that's the big difference maker, weaker dollar. The big change is we just get back to recession classic. So the bonds bounce. Gold maybe pulls back because term premium unclenches, to Chris's point. But the risk environment doesn't look like it's going to get any better.
What about the whole Sosnofian concept that 3 months from now, like basically what do you need to see, Ilya? Like Tesla's expectations were already terrible. To the point you made, forget the Tesla numbers and
they turned out even worse.
Actuals. The Tesla's
still at 239, by the way. It's higher.
And they turned out even worse.
Right. And the market's like, Sosnov's point is you're there. Okay, tell me something. The only debate is not is there a slowdown, not like with all the things you can teach a class. This dollar smile, regime change, slowdown, movement of goods and services.
Sure.
Enjoy yourself. Okay? The only debate is how to deal with it from a trading perspective. I mean, there's a whole other thing to talk about from a policy perspective, from an employment perspective, from society, from investment. It's Tasty Trade, tastylive. This is a trading discussion. It's a trading community. It's what it is.
I think that's the best reason to be a bear. The trend is down. Show me a trend that isn't down.
Because I'm saying Tesla tells you wrong. Tesla says, I can come in at half or a third or a quarter below reduced expectations, and they still will bid my stock.
Because it doesn't matter. And this was
my whole point. That's my whole point. That's my point.
Right. It doesn't matter whether they beat or don't beat, because that's not what is animating markets. What is animating markets isn't have we reached all the stock of bad news, or we maybe reached it, or what reaching it means. Nobody is asking that question because everybody has been shown since the beginning of the year that you never run out of bad news.
But the market's there. Volatility is going to come in by half to 2/3. Sosnoff is dead, got him dead to rights. If you don't sell the volatility today, then don't be calling me from this summer when you want to buy a house the size of Chris Vecchio's and you don't have the money anymore because you didn't sell premium.
I think if you want to do that, you sell the vol just in bonds.
You don't get one of those giant Vecchio ape shit long mansions from November 23. They're renaming it actually. There's the Vecchio. I'm going to try to get
Vecchio.
I'm less than half an acre, Dylan.
you put an ape shit across the front. This might be the time to go ape shit short premium. I'm just saying.
I mean, you need the space for the leather works, in fairness.
All right, listen. I'm here being very polite. I've been very polite here all day, letting you two go back and forth. Now I'm catching strays for no reason. Okay.
There's no saddle making without space.
Just log on.
It's a labor-intensive, square footage-intensive endeavor.
Look, I think also said the opposite throughout all this. They pointed out, quote, changing political sentiment, unquote, which, quote, could have a meaningful impact on demand for our products in the near term, unquote. Yeah, I'd say so, right? How much of this was already priced in, right? We have cyber that may be coming in 26. I mean, we are $2 higher than where we closed.
And this report is an abomination.
And it was a nuke. So that perhaps is the good news, right? Earnings.
That's what I'm saying. That's the
maybe this is the indication, right? This, Netflix has really good earnings. Their shares the last few days have been doing quite well, right? Netflix here, a modern day consumer staple. You're not going to go out anymore. There's a recession coming. You're still going to stream. You're still going to need your, Netflix and your Philip Morris.
More than ever, you lost your job. All you got left is to watch Netflix.
And smoke and drink your Coca-Cola. And then, because that's all bad for you, you take your Ozempic shot.
Play video games, get some weed.
Right. Yeah. And there's
problem.
Well, no, but you see like
a wheel of cheese.
You see that
the Anthony Bourdain special. Rest in peace.
I think there's a framework here to work with right now. Yeah, man, I could go for an Anthony Bourdain special after
you do a real big cooking. We'll stay home and just watch Anthony eat things and talk to people.
Yeah.
Yeah, gotta get a reason. Like I'll go get some beer after work and a pack of cigarettes and
get some in town and
the rest of it
and a
Coke.
That's some cigarettes.
Yeah. Okay. So Tesla here. To you have Netflix, which beats and is heavily rewarded by the market, even though obviously the future is uncertain. Tesla is nuked, and the future is uncertain, but it's not going anywhere. I think there are some just sentiment breadcrumbs that, unless we careen further from here, people are clearly looking to try to make this a low in the market right now. I don't know if I would be.
Which is why I find Ilya fascinating, because he's like, take advantage of this and sell and get, even if it's with a directional vertical. I mean, I think there's a lot of, I admire Ilya's confidence, and it might well turn out to be obviously the right decision. But I feel
I don't think we're out of the woods yet. I think we could probably see a bounce back here, right? Depending upon what Musk says, if we get a little rally overnight. But the next few weeks, we could stay in this topsy-turvy, both in ES and in Q. Yeah. At least in NQ for the next 2 weeks, for ES, maybe the next 3 or 4. So it's tough to put stock in anything. Like with Besson today, great rumor. You get the details. There's no bargaining going on at all. The negotiating hasn't even started. So more chop, I think, is what the fair play is here, Dylan. I think more chop. If Tom says, this is an environment where, if you look out 3 months from now, you're going to be disappointed.
Yeah, my perception is that Ilya's like, no, when you get rally, maybe I'm conflating the two. Maybe they're all one and the same. But I feel like Ilya's saying, no, you should be confident enough when the market gets a little bump like this. You just say, to your point, Ilya, you said, I'm hopeful when liquidity comes back to be a bump. And then if there's a bump, I'm going to use it as a chance to get short, which I think has been working pretty well. It's the thing that works is be on the other side of this thing, because he's always going to say something crazy that's going to make the market. They're always going to do something crazy to make the market go down. Always, and then they're always going to double talk their way back. The same as today was it was like a classic Trumpian Trumpster, Trumpistan, And in Trumpistan,
look at what we see here.
You should do a book, Ilya, Trading Trumpistan.
I mean, just the price action. So you get that massive green bar when the reciprocal tariffs get capped for 90 days at 10%. You hit former support at the previous range bottom. You stopped right there. What did we say? We said, what does it mean that you stopped right there? There was no conviction to actually overturn the breakdown. The breakdown was wild. The rebound was wild.
Right, but if you got Vecchio out there on the same day doing math, which is their worst case scenario, with people doing math in public.
Right. And we all sat here and said, wait, did they fix anything? Hold on.
Made it worse. And there's like 1,000 Vecchios doing math in public everywhere.
Since then, is that how many of
this thing developed a range, right?
Doing math in public?
That's a bad thing to do, man. You got to be careful. I'll be doing math in public, saying things.
I believe they call it the Singapore special.
Yeah,
but
Ilya, the other side of
what
it
happens
is,
when you chew gum in the street?
Well, how about sell premium and don't worry about direction? If there was
in
ever
the bonds, I can understand. In the bonds, I can understand. If you're going to be a seller of premium in this environment, the thing that doesn't make sense to me is that there is this ongoing panic in the bonds. I get why the panic is occurring, I think, because if you look at the surge in gold parallel to a dollar sell-off, parallel to a surge in term premium, and not just in absolute terms, but the share of term premium in bond yields, that basically tells you the share of the yield that is compensation for time uncertainty. Like, oh no, over the duration of this, crazy stuff is going to happen. You need to pay me in case. That's the biggest share of the yield since May 2021. That's not accidental. There is a connection there. And so you look at all of that and you say, okay, but the US dollar is still the undisputed global reserve currency, and the US, for all its many, many, many warts here, is still the most eligible borrower because its asset base is still greater than anywhere else, full stop. And so,
and liquidity, and then the list goes on and on and on. You know, entertainment,
and there's an
government,
economic
finance,
downturn, and
technology,
inflation expectations are falling. The
AI,
Fed's going to cut.
you know, blah. Come on. Space.
Right?
What do you want?
Why not just
So
buy
the thing here is the bonds bounce. To me, the resolution is the bonds bounce.
Bonds bounce and gold sells off, but
Yeah.
Dylan, is the trust is gained in?
I just want to leverage short volatility. I just want a short premium to 45 days. I want a short premium 45 days out. I don't want to kick myself. I want to have a good time at the beach.
Then why not just buy out of the money Bitcoin calls? You know, if we're heading into this world that we're all talking about, where there's de-escalation and there's help coming along the way and stimulus or some backing down.
Yeah, just some sort of anything. It's just acceptance. I'm not.
Acceptance. But then there's now a permanent discount attached to American leadership, the viability of America.
Volatility still comes in.
No, volatility comes in, but what?
Even if you think you're like, oh, that's a bunch of idiots. You're like, okay, at least we know that's a bunch of idiots. Like, put them in the bucket of idiots.
Right, which volatility comes in is really the question.
Yeah, stock volatility.
Is it economic volatility or U.S.
or
financial architecture volatility?
I don't know.
I think the former, no. The latter, yes.
I don't know. The point I'm trying to get around is that I'm trying to talk myself into looking for some high convexity upside exposure in Bitcoin right now.
You're going back to $1.10 the other way. You're just going to take it hard on a Bitcoin Mad Dogger.
Yeah, and IBIT right now, for people who want to do this via the ETF, it's the high sit around 61. I'm sizing up long the 55, and depending upon your risk tolerance, even long the 60, short the 70. It's a 22% probability of profit, but it's giving you a little bit of that 7 to 1, we'll call it, territory, and over a 59-day window. I feel like gold is going to take a backseat. I don't know why. Just this whole 25% above the 200-day and Bitcoin holding up.
I agree with you.
Like, listen, Bitcoin was up huge yesterday when the world is falling apart. Bond yields up, dollar down, stocks down. Well, dollar's up today, stocks are up, and bond yields are down, and Bitcoin's still up. And that liquidity is coming back in, right? Global money supply is increased.
And there's still a marginal move away from the dollar wherever you can be done, even if it's a social
which
thing.
Will probably continue.
Yeah.
And if Trump is going to flirt with firing Powell, does that mean marginally that you trust the stability of the U.S. dollar, or do you want to have an alternative store of value? If Trump is going to start pinning interest rates lower and we go into an MMT world, does that mean that we're likely to have a yield curve control possible outcome? I would say so. If we have yield curve control, what does that do for an economy where you have stagflation in the backdrop? You probably have capital controls, which makes Bitcoin look a hell of a lot more interesting.
I mean, I can't
theoretical, more of a practical framework.
Can't believe I'm about to say this, but I think the euro is a better store of value.
That is
because they're about to spend all this money. Well, they're about to spend all this money on defense, which has the markets expecting that maybe they'll even hike rates next year, and the euro pays yield. So if you're gonna go to government-backed fiat, which I think is a much safer refuge in this environment than anything that isn't government-backed fiat, because it's backed by governments, and that's very meaningful actually, because governments have guns. If you have this massive build out in Europe and they're spending all this money because suddenly they've gotten religion on mutualized defense and the unreliability of their transatlantic blanket, as it were, if that's what's happening next year, rates in Europe are going to be higher. Meanwhile, the U.S. is going to be cutting. The euro is already surging on this basis, but looks like there's probably more to go. So if I was going to hide out from regime change to a weaker dollar for X number of years, let's call it 3, then I would be looking at the euro, and I'm long. I've been long. When the futures roll over, I'll probably get long again the next contract, depending on where it is. I'm planning to be a buyer of euros for a while. Not in a linear fashion, obviously, when
but would you do a high convexity? Are you suggesting that you'd rather be like between now and to Chris's point?
I'd rather own euros than Bitcoin.
As a even in the short term, you'd rather be long euro for the next 45 days.
Yes.
Becky was silent and with a skeptical facial expression.
We've gone 10%. You think that there's more potential for upside in the euro over the next 30 days than Bitcoin, 90 days than Bitcoin?
No, I'm just saying I would rather own it.
Okay.
Well, what's that based on? Since I think
there is a greater
respect.
I think there is a greater likelihood that if there is another wave of risk aversion, which to me seems likely, and obviously I'm selling
over
stock
the next 90 days, we're getting to July 4th here, pal.
Yes.
Maybe July. Maybe.
Obviously, I just sold more. Obviously, I just sold more stock, and so embedded into that idea. And by the way, my duration on this stuff is 60 days, 59 days to be specific. So I gave myself lots of room for tweets and
the 22nd May
take backs and whatever.
You're on the summer solstice. I want another month.
So I've just re-upped there. By the way, if it looks like I'm wrong tomorrow, I'll change my mind because I'm a trader.
We've seen what you do.
Right? So that's what it'll be. So the price action at the end is king. I'm trying to make money, not be right. And I don't care about being right. I care about having positive P&L in my account. So for me, I look at this and go, okay, if I think the trend in stocks is down and the range has broken yesterday and today was a nice backfill of the break that gives you a mulligan to sell it, and I'm short stocks, then I'm betting on risk aversion. If I'm betting on risk aversion, Bitcoin is not going to do well in that risk aversion relative to the euro. The euro is going to be the haven of choice. We've seen it through all of this. As money comes out of U.S. stocks, it also comes out of the dollar and shifts elsewhere. And the elsewhere of choice, liquidity, stability, government backing, prospects for higher yields next year, all of it is euro. So absolutely, if I'm expecting risk aversion, which may or may not come, but if I'm positioning myself for risk aversion, then of course I'd rather own euro than a high sensitivity to risk type of speculative instrument like Bitcoin. Absolutely. That doesn't mean I'm right, obviously. But that's the way I'm trading it right now.
Would you short Tesla volatility?
I
know
don't
you don't do
think
individual names. I know you. I mean, let's assume you did names. Would you, or a Mag 7 vol number, or a Nasdaq vol?
I don't think that's the place to do it. I think that the place to do it is in the bonds, because the one thing that looks off sides in all of this is the idea that you are going to have Fed rate cuts, that the central bank now has to figure out how it manages to do what it's been wanting to do since last year without now, because of the president's shenanigans, looking like it's kowtowing to the White House. So if anything, the president has made rate cuts more distant, and you can have whatever sort of thought process you can about this is all 4D chess. He knew that that was going to be the thing, and he's doing it on purpose because he wants to actually delay rate cuts. And if they're not delayed, then he can get to say, I'm all powerful. And if they are delayed, then he gets to say, oh, well, look, all of the things that I've been attempting to engineer, the weaker dollar, the reshuffling of paper wealth in the stock market, all of it is still working. And the Fed still has to cut. So eventually I still look like a genius. You can have that conversation. I don't think it's that coordinated or that planned, but I'm not opposed to entertaining that argument. It would be consistent with everything else that's going on. So if you look at it that way, then what you're essentially facing here is a situation where the thing that needs to adjust is the bonds. The thing that's wrong in all of this is the bonds, because the dollar is not going away as the global currency of commerce. The U.S. is still the most eligible borrower, and the thing that resolves the weirdness here is Fed rate cuts and the bonds going higher. And everything else just keeps going. Risk off, weaker dollar, blah, blah, blah. So if you're going to sell vol, and I am, by the way, I'm selling
what
vol.
Do you say, bud?
I'm saying vol. I'm selling vol in TLT.
I still like selling puts and put spreads in bonds in notes. It makes a lot of sense to stay directionally neutral. I still have the short iron condor on in there. So a day like today, that's basically a doji. Is give me a doji every single day for the duration of this trade, and I'll be a happy camper. But we're at the 50% mark here in notes in ZN, which at a 61 IVR, if people are looking for directionally neutral or directional neutral opportunities, this is a place to do it right now. And it's a smaller contract than ZB, so it's a little bit more approachable for retail traders. IVRs are close enough. I think the technical reversals today across the board are noteworthy. I think stocks can probably bounce a little bit. I just think that we've the genie's out of the bottle now. Toothpaste is out of the tube, Dylan. Right? Like, it doesn't matter if Trump comes. I actually don't think it matters if Trump comes out tonight and says, just kidding, everything since April 2nd's been a joke. It was actually one elaborate April Fool's Day joke. Ha 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 ha. Trade relationships aren't going to go back to where they were overnight. And companies that were laid off, that have laid off workers, aren't magically going to reopen their shops, because the contracts that they've had to cancel or pass on aren't just going to materialize out of thin air again. So,
and Europe's not going to go from spending 50 cents on every euro here to 3 cents on every euro here. You know, that's a long-term reallocation of the marginal non-U.S. liquid asset away from the U.S.
And there's been no rhyme or reason through all this. It's just been on the arbitrary and capricious whims of one person in the White House. And you've noticed a lot recently, the stream of commentary from Hassett, Lutnick, Bessent, Navarro, Musk, it's all quieted down. You're not hearing it multiple times a day from multiple different advisors, because they were all effectively neutered. They would say something and Trump would almost be watching them and go, okay, time for me to pull the rug on their credibility, and then say something diametrically opposed to it. So everything is in Trump's hands right now. We are waiting. We are watching. And we'll do this all again tonight, because overtime is out of time for this Tuesday, April 22nd. We'll be back tomorrow. Same time, same place, 4 p.m. Eastern, 3 Central, right after last call. So for Ilya Spivak in San Francisco, Dylan Radigan in Milan, I've been Chris Vecchio in New York. We'll see everyone in a little bit. Quick break. Tasty at Night coming at you, starting with Ilya Spivak and Macro Money.
See you there, everybody.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
it up, stop when the clock hits 13. Sing 1, 2, 3, 4. Cause no one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it, like we do it, like we do it.
Your crypto needs a wallet, and crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
One of the things that was most intriguing about the financial space to us is just that there wasn't a lot of vision. There wasn't a lot of innovation. After almost 20 years of open outcry standing in the pit trading, I felt like all the markets were moving to electronic trading. I saw the writing on the wall, and I wanted to be first. Building the best technology in the world for traders was one of the coolest things anybody could ever do. I loved every second of it.
Thinkorswim will always be my baby, but this one, it's different. We built ours literally from scratch. It's a much thinner, it's a faster, it's a slicker application. Everything's on one page. So you're always looking at the core page and then bouncing around from there to get to whatever you want to get to. We're here to support whatever you're looking to do. We have the tools that you need to be a successful trader.
Got trader's block? We've got the cure. Get data-driven trade ideas with Cherry Picks, our weekly newsletter that gives you insights into the market. Sign up at tastylive.com/newsletters.
What's up, everybody? Check out my new series, Life Cycle of a Trade, where I show you my real-time trades with insights into strategy selection, adjustment mechanics, all the way to the closing order for all of the tastylive core strategies. Tom, when you're scooping the offer, what are you doing?
That means when you're scooping the offer, you are buying whatever you can get your hands on at the best available price.
What does it mean when something trades by appointment?
Trading by appointment is when you're in a pit back in the day that had one or two market makers in it, and if they were having lunch, you had to make an appointment to make a trade with them.
In the pit, if you said, I'm going to buy your book, what did you mean?
If you're going to buy the book, that means you're going to buy everything that is posted in an electronic book. So every resting order that's posted in the book up until a certain amount.
If you say take a fill, what's happening?
If I'm taking a fill, that means I'm a broker, and if I'm a broker, that means I did something horribly wrong because I'm a market maker.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it. We get it.
The U.S. dollar manages to find a little bit of support as stocks unclench and the bond market again finds a familiar bottom. Are we perhaps starting to flirt with the possibility that the worst is over after a rough start to this week? Or is this the temporary bit? Is this the reprieve? And are we going into something more scary and uncomfortable as the week progresses? That's what we are going to unpack here as we break down these markets on Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live, and today we are going to put a lens on this conversation that is going to approach what's happening from the perspective of the U.S. dollar and sort of the window that it offers on what the situation is, how it is developing, and what is likely to come from here. Because, of course, there is a diversity of markets here showing various things, but what we certainly find here is that there is a situation where the most liquid of all markets and the sort of cash of choice for global investors is shaping up, if only as an indicator, to be one of the more glaring sort of signals suggesting that what we might have been used to before is not what these markets are currently showing us, and that whatever may be a near-term resolution or a near-term recovery might not be appropriately treated were we to wear the same hat that we might have worn as investors over the past 40, 50 years. That in fact, what we are entering is a period that is fundamentally different from not necessarily all history, of course. Economic history is tremendously varied and diverse, but a period different from the post-war normal that has persisted basically since the untethering of the U.S. dollar from the gold standard in the early 1970s by the Nixon administration. So let's take a look here and unpack what currency markets seem to be saying here and how that might then extrapolate elsewhere. So first things first, this is the dollar index, and what this is albeit an imperfect, but the standard basket measuring the dollar's performance against its major counterparts. I say imperfect because this basket was created before there was a euro. And so this was a diversified basket at one point because it included currencies like the Swiss franc in addition to a French franc. It included a German Deutschmark, an Italian lira. And obviously, while the Swiss franc is still its own currency, its significance has diminished in global trade by leaps and bounds, and many of the others have fused together into the euro. And so the basket is a bit skewed to an older reality than what persists now. Tellingly, this basket doesn't include, for example, the Australian dollar, which is now the fourth most traded global currency because of its reflection of the rise of China, and China's own currency being something that's tied up onshore with various capital controls and competing exchange rates and what have you. So it's not a great basket, but it does tell a story. And the story here clearly is one of dramatic U.S. dollar weakness since the beginning of the year. Now, it's important to put this dollar weakness in context because it is happening under very unusual circumstances for what the financial architecture might have been expected to produce. So here's the beginning of the year. We can see the dollar is selling off. Now, this is happening at the same time that stock markets are selling off. Here is the decline, obviously, in the S&P 500 as a kind of benchmark for what's going on. That starts to be something that is activated, let's call it early to mid-February or so. That's where we sort of establish the beginning of the move, but you'll notice the highs actually are set all the way back in early December as we start to get ready for the transition into the into the calendar turn, and of course the administration in Washington D.C. Turn from 2024 into 2025, and we set the high in December. We ultimately never set another one, but the sell-off starts a little bit later. We likewise, and this is sort of something that's been occurring more recently, going to the beginning of April, are seeing a sharp decline in the bond market. Now, we can see that since the beginning of the year, this part of the equation was actually moving in the other direction and working as you might expect. So we start with there is a growth scare because economic data that starts coming out in late February begins to show that business and consumer confidence has been severely hampered by uncertainty around the rollout of the Trump administration's new fiscal policy. That's at least what consumers and businesses are telling in these surveys. And what you then see is they're holding back on economic activity as a consequence of that uncertainty. And because they're holding back on it, economic activity significantly slows. And so the markets say, oh, well, okay, so this means earnings down, right? Stocks begin to decline. And the Fed is probably going to have to cut rates to combat whatever economic malaise is coming. So bonds up. We, of course, know bonds move inversely, bond prices, that is, move inversely with bond yields. So you get bonds higher as you see expectations for stimulus build. And indeed, if we take a look at what is being priced into Fed funds futures, we can see that indeed, since the point where stocks begin to sell off, you get a more dovish shift in Fed policy expectations, both for this year and next year, but most importantly, for this year. You go from a cumulative of about 50 basis points in cuts over this year and next being priced in around the start of February, and the outlook for this year being a single rate cut of about 25 basis points being baked in. You've now gone to closer to 90 basis points. And so, of course, you see the response in bond markets as you might expect to see it. So far, so good. Everything here seems to follow familiar norms. But then the bond market marks a strange turn. At the beginning of April, there is this violent sell-off where bonds crash, yields surge. And against that backdrop, stocks keep selling off. Here's April and that push through support at just above 5,500 on the S&P that follows with that bond sell-off. And again, most interestingly, the dollar sells off also at the same time. So whereas this, you might surmise, makes perfect sense because, okay, stocks are selling off, the Fed is going to cut rates, weaker growth, lower yields. So the yield-based support for the dollar is eroding because if the Fed is going to cut aggressively, that'll undermine the dollar's yield advantage against other currencies. Very, very classic. Dollar sells off. Here, this looks a bit odd. Not only in its violence, but also in its direction. Because this is happening as yields rise and stocks sell off. Now, we've talked about this extensively before, and we'll come back to it here because it is a useful view on what we are seeing here. This is the dollar smile model developed by economists Stephen Jen. And what we see here is the relationship of the dollar to global growth dynamics that really reflects how the dollar has worked since untethering from the gold standard occurs in the early 1970s, and really describes what the financial architecture, what the monetary architecture of the current financial system has been over that time. So we're looking at about 5 decades here. And so what we see on the bottom here is the relative outperformance or underperformance of the U.S. economy. So here's 0, where the U.S. economy is growing at about the same rate as its G7 major counterparts, so other big developed economies. In this direction, the U.S. is underperforming. In this direction, it is outperforming. So here the U.S. is growing faster. Here the U.S. is growing slower. And we relate this to the value of the dollar. We can see here that the dollar is relatively stronger, that is up relative to here, up relative to here, 0, when the U.S. is either doing much better or when the U.S. is doing much worse than its global economic peers, such as they are. Now, why is this? This is obviously special. This is obviously different from other major currencies. This is because the dollar is the quintessential unit of global commerce. We're going to get an updated set of these statistics from the Bank of International Settlements this year. They publish them every 3 years, and 2025 is one of those years where they're going to update it. But most recently, we see 88% of global monetary transactions are settled in the U.S. dollar. And that is because of its unrivaled liquidity. So when the U.S. is outperforming, it's the usual story. Oh, well, U.S. is growing faster, so the Fed is hiking rates more, so the dollar's yield advantage builds, dollar goes up. This is how all currencies work for the most part. If the economy is strong, inflation expectations go up, central bank raises rates, yields on the currency become more appealing, and people buy it. It goes up. That's textbook. What's exceptional about the dollar here is its unrivaled liquidity means that when there is some sort of turmoil, such as when the world's largest economy is going into a crisis or a recession, like this, where the U.S. is underperforming and dragging down everyone along because it is the world's largest economy and the deepest consumer market, capital flees to safety. People cash out of riskier assets, but what is their cash of choice? It is the dollar, or has been. And the reason it has been is because of this unrivaled liquidity. It's easy to come in and out. It's not something that's going to move a lot with huge capital inflows and outflows relative to other currencies. And of course, because of its built-in underpinnings as the indispensable unit of commercial exchange, there is the very strong basis of mutualized necessity. Global commerce needs a vehicle. Secondly, because it is underpinned by the faith and credit of the U.S. government, which is, for all its warts, the world's most eligible borrower because it is sitting on the absolutely biggest asset base in the known universe. It's got a lot of collateral to put up, and more collateral than pretty much any other borrower that we know of. So, not surprisingly, the dollar becomes the cash of choice in anti-risk or risk aversion times. If this was the regime before April of this year, it is obviously not the regime now, because neither higher yields, that is lower bonds, or risk aversion are doing anything to help the dollar here. It is unable to take heart from any of the traditional vectors of support. It is in fact going the other way. And the explanation seems to be a breakdown in the architecture itself, where what you see around fiscal policy uncertainty most critically is first, and perhaps foremost, a jump in term premium baked within U.S. Treasury yields. That is to say, the cost of compensating for duration risk, the cost of paying for U.S. fiscal uncertainty, has jumped to the highest since May of 2021, on the eve of the Fed's rate hike cycle, on the eve of the Fed admitting that it needs that rate hike cycle in the middle of 2021, which is a huge inflection point post-COVID for global markets. And so what you then find is that this growing risk is driving capital out of U.S. dollar-denominated assets writ large, be they the dollar or U.S. stocks or U.S. bonds. Everything is falling in tandem. Moreover, this uncertainty is translating into expectations of a steep recession that then brings inflation net down, despite the fact that ostensibly the catalyst for all of this is the increase in tariffs that the new Trump administration has announced that will lift prices on virtually everything, because it increases the prices of inputs as well as of imported finished goods, and thereby lifts overall price levels. That this is being reflected as falling inflation expectations, so-called break-even rates, baked into bonds, suggests that the markets are already seeing through the rise in costs and to the economic damage that it will cause, and the recession that will follow, and the loss of demand that will follow. And that what this will do is actually end up with net lower inflation, not higher, because of the economic damage. We can see that show up, of course, in the flow of economic data. We've used this Atlanta Fed GDP Now model as a kind of barometer for the direction of economic data, and we can see that the inputs into this model, which is updated anytime that a big piece of economic data comes out, hence the nowcast sort of nature of this, we can see the tone of the data has clearly been negative, because what it's done since February is push the model lower and lower and lower. Never mind whether we actually get a growth rate of between 2 and 3% on the downside when Q1 GDP numbers actually come out. That may or may not occur, and ultimately isn't what's important here. What's important is that the model is sloped the way it is, suggests the inputs that have been going into it have looked abysmal. And so, needless to say, of course, as we just saw, this has translated into the idea that the Fed is going to have to cut rates to battle an economic downturn, which of course is already in the markets to some extent. We can see this adjustment. Perhaps as more economic data comes in, more of an adjustment might be necessary. As it stands, the first rate cut seems to be on the menu for July, after which we start to see a more accelerated pace lower. And looking at the numbers we've started to see on what the economic growth picture around the world is looking like, maybe there's a reason to see this move into a still more dovish sort of setting. We just got numbers today from the IMF. They updated their world economic outlook, and we can see that, not surprisingly, the direction of travel is overwhelmingly lower. So for world GDP expectations for 2025 marked down versus the outlook in January, which was itself a markdown from the outlook in 2024's last update in October. So clearly, this is looking meaningfully weaker than sort of the recent expectations. That extends to the advanced economies, of course, to the United States, which actually sees the biggest downward revision in expectations for 2025, sort of amongst the majors, and also the biggest, or one of the biggest ones, the only bigger one it seems like is China for 2026. And we can just see the negative numbers here pretty much across the board for everyone except Spain, of all things. But Spain is not a big enough economy to right the ship if the U.S. and China and the euro area more broadly is looking weaker. We are going to now get a set of PMI data over the next 24 hours that may well speak further in this direction. The expectation is weakening Australia, back to contraction territory here, weakening in the Eurozone, a softer flavor of standstill there, weakening in the UK, a return toward standstill there, and for the US, significantly weaker service sector performance and a return to contraction in manufacturing that almost certainly brings us closer to standstill on the composite after a bounce in the previous month's numbers. So all in, this seems to translate to still lower interest rates and still more of a pressure for more easing from the Fed to combat whatever economic downturn is being flagged right here, which of course, again, is bad news for the US dollar. So in that the dollar is unable to find its familiar support, and in the longer term conclusion that probably all of this resolves as the markets anticipate in a Fed that's more dovish, lower interest rates, and eventual rate cuts of size, probably means that this move here is perhaps far from over, and that we're looking at structural regime change. And if that's the case in currency markets, it may well be the case more broadly. Because if we are going into some sort of whole new architecture on the price of cash, the cash that powers the global system and almost certainly will continue to power it, well, then the reaction function elsewhere, almost by default, might be considered different, and the environment as a whole might start behaving in ways that we're not used to in recent decades for a much longer period of time. And of course, for traders, the upshot here is any pull-up in the US dollar near term, because of course markets don't move in straight lines, probably looks more like a sell than anything resembling a trend change. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. In 30 minutes' time, I'll be on with Victor Jones for The Price of Truth, as I am every Tuesday. Back with Chris for First Call on or for Futures Power Hour rather on Friday. Back with Victor for First Call and with Tom on Sundays. Writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Good.
Shake it up, stop when the clock hits 13. Sing 1, 2, 3, 4. Cause no one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it, like we do it, like we do it.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
I tend to call myself a lonely options trader because I really don't have a lot of people that I can share stories of wins and losses with. Like Tasty Live plays the whole day at my house. I love that they've made everything really easy to digest and take in. I love that you can easily send an email if you have any questions and Tom will be quick to respond to you, or if somebody else, Nick, Tony. I really enjoy that it's a customer focused and it's a customer centric system that you guys have here. And Tasty Live has definitely changed my life financially because I'm able to determine how and where I can make my gains and not be a passive investor where you're just relying on the markets to do something for you. You could actually go out there and do it yourself.
We built Tasty Trade's web platform for today's traders. Drill into data, find opportunity, and track the action with hundreds of indicators. Fund your account and start trading right in the app. Join the club. Tasty Trade.
If you missed the live show, here's our cherry on top weekly recap.
Vanetta, welcome home.
I have been trying to wear this outfit for the last 6 days. I thought I had the next 4 years off, honey. I was looking at property in Boca.
You still get Easter bets. I'm not getting one because we get one for Nick and Gina and Sasha. They're all in their 30s now, and Chandler's 30. I mean, I'm not getting them anymore.
But no, if you have older kids, it's nice to know that you're thinking of, like, Nikki would love a DraftKings gift card.
Get him a basket with the stuff hanging out in chocolate.
DraftKings gift card for Nikki would be a waste of money.
No, a DraftKings gift card for Nikki. That's a good basket. And some Zins. You put some Zins in there and some Prime energy drinks. A DraftKings gift card.
I got one of those in the.
Yeah.
More importantly, I gotta ask a question. More importantly.
That's his favorite catchphrase, and honestly, it's got to be a Tasty Trade T-shirt. More importantly,
I agree with you. More importantly, it's going to have to be a T-shirt. We're going to get one of those made for sure.
Get the full scoop by checking out the archives at tastylive.com.
What is going on, everybody, and welcome back to Risk and Reward with Gus and E. Gus, been really volatile over the last couple of days, first couple of days getting into the week, but I know we got a new Risk of the Week to put on, so we'll catch up to all of that before we do what's going on, what's new. How we doing? Blank white shirt today. I don't know what that means. I don't know what you're indicating from that, but
the fun shirts are just for Thursdays. That's the last stream of the week. We gotta roll out. I actually just did my tally this morning as I was getting dressed, and I have, I think, 2 fun shirts left that have not been debuted yet, and then I will have to go shopping if this is going to be my thing now. But no, I'm feeling good. Yeah. Portfolio, as I've mentioned a lot, is mostly shares right now, which means that on any green day, I look like the greatest trader in the history of the world. I have 17 positions. Right. Every single one of them closed the day green, so it's hard to complain when you're in that position. So yeah, feeling good.
Nice.
And yeah, this plain white shirt, it has me thinking about my school uniform when I was a kid. Mom, if you're watching, you're probably laughing at that one. But yeah, it's it makes me think of when I was a kid, we always just had the stock white shirt. I actually caught myself in the mirror today, and I was like, man, I swore I would never dress like this again.
Reminiscent. Yeah, here we are, full circle moment. But no, an extreme reversal in the market today. I know it played out with the positions like you kind of just mentioned there. Kind of same thing on this end over here. I know some of the more neutral positions didn't reap as much as of the reward, but a lot of those directional positions definitely. I mean, what a reversal from yesterday just to today. So I know some of the risks that we put on yesterday, I think we both put on long delta, but both of those should be looking pretty good at about this time right now. I know we'll talk a little bit more about that and get another risk of the week on today, but no, it's been volatile. I know we had an extreme sell-off yesterday out of the gate, and then we gave everything back today and some. So we'll get into this risk of the week, putting on real risk behind one stock that we believe has edge. Was it a difficult decision for today, Gus, as we get into our first one for the week?
Yeah. I mean, it was, there was lots that I tossed around. I ultimately kind of have decided to go with a content stock, but we'll get to that in a minute.
A content stock. Okay.
Yeah. But it was a tough choice. A lot of attractive options, directionality really hard to determine. So we'll get into it, but I'll let you go first.
I feel like right now there's a lot of underlyings that we could choose for some volatility, but I thought it was only right to bring up gold. Gold has been going on a 97, 99 Bulls Michael Jordan run. I don't think we've seen anything since. So I'm looking at gold here. I know gold had another leg up after that insane rally that we saw last week. And at these levels, it's starting to look a little bit more attractive. So I chose gold for this one around. Gold hit a record high of 3,500 ounces on April 22nd. Gold followed closely with nearly $6 billion in Q1 inflows, one of the highest quarterly inflows ever. Investor demand surges as flight to safety. As we know, gold, whenever things get a little rocky, a little uncertainty, people get fearful. People will kind of run towards gold. So I want to take advantage of that a little bit. And then we got a lot of Trump's criticism. I'm curious about your thoughts on this. Trump wants Jerome Powell out of here. What are your thoughts on that? How do you think that's going to react on the market if that moves forward any bit? Curious.
Yeah, I don't know. I thought that maybe we cooled off a little bit on this today, but it seems we may have not. The news is always incredibly mixed. But yeah, I don't know. I think it's interesting. I don't think it's going to happen. I don't think that there's any way it could happen.
No, that's massive. Is that just like headlines? That might
practicality.
Just be, yeah.
Well, I mean, I don't know that it's necessarily just headlines. I mean, I do believe that Trump has said this, but I just don't think that there's any way that this could ever actually come to fruition, especially because the Fed exists to be separate from politics and from the executive branch, and to react to what the executive branch does. Not be told what to do by the executive branch. There's a split in power there for a reason, and I don't think that there is any way that it'll actually come to fruition. But I did think it was interesting, and I do believe that was what drove the downward momentum yesterday, was the uncertainty surrounding that Powell situation. But yeah, I don't know. I've been keeping up with it. I mostly just chuckle, which is how I've been handling a lot of news these days. Is you just have to laugh sometimes. But yeah, I don't think it'll come to fruition. I do think it's interesting, and I don't fault the market for reacting the way that it has, because obviously that would be unprecedented if that were to happen.
Yeah, no, we see Jerome Powell out of here. I think we see a 1973, but I think that's a little far-fetched at this time, but it is always nice to get random volatility in the market if you're a trader. I know for long-term investing, things get a little scary there, but Goldman Sachs raised its year-end forecast to 3,700 due to just political and economic instability and a lot of oh yeah, I see some of the comments over here, and just a lot of the economic instability. So gold, just one of those safe havens. People feel a little safer running towards that. Bitcoin proving to not be the new digital gold, but gold still proving to be the gold we've always known and traded. So picking gold for this week. But what do you got over here? I see you.
Yeah, I was laughing because a part of my logic is actually going to be a criticism of Goldman Sachs. Yeah. Also, chat making me laugh. Somebody, Gus, does your soup strainer have a name? It took me a second for that to click. That was the mustache was even what you meant. It doesn't have a name. You guys are more than welcome to give this thing a name. I'm all ears. I'm open to ideas.
Fred comes to mind right off the bat. I just I don't know how you feel about that, but that's what I feel.
What'd you say?
Fred.
Fred? All right. Okay. We got Fred. Chat. Let us know how we're feeling.
Yeah. The personal branding is just on point. The shirts, the stash, the everything, guys.
I was telling my parents all through college. My parents, they both didn't like the look, and I said it's branding. I said you'll never forget me, and it's true. It would happen all the time. I'd meet people that I had a class with like 6 semesters prior, and they'd be like, "Gus," because I'm a recognizable fella, I suppose.
You already know. Yes, sir.
Anyway. I got my risk of the week, Victoria's Secret. Interesting play here. This is actually a stock I don't think I've ever traded before. But yeah, the top bullet point sums it up. Equal parts technical and sentiment here. On a technical side, super strong resistance. I should mention Victoria's Secret is trading right at about $17 right now to contextualize all this. Very strong historical resistance in the $15, $16 range. 9 bounces off that range since 2023. It goes and tests it a lot and tends to rip back upward. Just made their all-time low 2 weeks ago, which all-time lows aren't usually a thing that I talk about, but it is actually their all-time low. Like from IPO, it was never lower than it was on the 4th. And they've had 5 consecutive earnings beats, so I'm not too worried about the strength of the company. Sentiment-wise, Victoria's Secret is a recession buster. This is some knowledge that I've just become privy to recently, but Victoria's Secret actually does better in times of recession because when people have less disposable income to buy large luxury goods like, cars, jewelry, things like that, people tend to shift into cheaper luxury goods, which is what Victoria's Secret provides. So they tend to perform well in recession. Valentine's Day will be priced into this earnings cycle that's coming up. Summer is major wedding season. Some people do some shopping at Victoria's Secret before their weddings. It's all
wedding season. Okay,
all float out in the world. And then my last point: Goldman Sachs is stupid. I threw this in here just because Goldman they maintain their sell rating on Victoria's Secret today in a new release, cited instability in the company. But I've just been fed up with Goldman Sachs recently. It's actually ever since like last week or maybe the week before, they put out like their recession warning for the first time, and then the market reversed that day, and they just pulled it back down. And this is what happens with analyst ratings all the time. Is company is going up, they'll switch it to buy. Company is going down, they'll switch it to sell. These ratings mean nothing. They can rate things however they want, whenever they want. So I'm not paying too much mind, I guess, to that rating. Just rocking with Victoria's Secret. And I'm wondering if there's going to be maybe some 4D chess happenings where if recession fears begin to mount, people are going to start sentiment putting money into Victoria's Secret. This isn't a, unknown fact. Lots of people, I found this just on the surface internet that Victoria's Secret performs well in recessions. I don't doubt that other people are seeing the same things. Taking a play on Victoria's Secret. I am going to grab this one tomorrow morning. I'm breaking the rules, but quite frankly, I didn't want to deal with this Tesla earnings cycle. I had no idea what that was going to do to the market as a whole, which we'll get into that in a second. Very interesting dichotomy happening there. But gonna throw this on tomorrow morning. Unsure of exactly how I'm going to do structure. Probably defined risk and relatively long term. I would kind of like to give this 60 days to eat. So that's how I'm feeling.
Yeah, we'll go into the options chains here in a minute on both of the underlines, check them out, see what the premium is looking like. But I like it. Goldman Sachs is stupid. Maybe it's just the kind of the pessimistic outlook on consumer spending and just retail in general, maybe with the downgrades. But maybe they need to be looking to get long on Victoria's Secret. So let's pull up this options chain and see what these underlines are looking like right now. So I have a handful of positions still on. I know last week we did Tesla. Tesla's having earnings right now, if anybody wasn't aware of that. We'll go ahead and pull that up, see what that's looking like right now. This will load. And yes, Gus, I had to hold this one through. This wouldn't be a real risk of the week if I didn't hold this one through earnings. But because it is a defined risk, I was like, you know what? I'll hold it. As of right now, Tesla is rallying. I know right after the bell was kind of break even. We rallied to the upside, rallied to the downside. I do have an out of the money put spread that I sold on here. So maybe I can be able to collect a decent amount of credit by the time the market opens tomorrow. But it's looking like we're going to end up gapping up on Tesla. As we pull this back up, didn't even realize we were pushing to the upside. It was kind of quiet for a little bit.
Well, yeah, and they've totally flopped on earnings, which is interesting. That's kind of what I was getting at earlier. Badly missed both estimates. Reported 27 cents EPS on 41 cent estimates. That's a 14 cent miss, 34%, if that's how you prefer to quantify.
That's why I don't even like earnings.
Yeah.
That's why I don't prefer earnings.
Well,
for that exact reason.
My logic with this earnings and why I respect you for playing it at all is that the numbers were probably going to be bad, but they were also probably going to give some foreguidance along the lines of Musk is returning to the company in X number of days. And so I didn't really know how those two forces were going to pull on each other. Shout out Tom. He nailed this on the head earlier today. He said Tesla is going to miss earnings and nothing will happen. And that's exactly what we're seeing. So yeah, it's just, I don't know. It's fascinating, but yeah, we're up huge post-market now. I didn't even realize how much this has ripped upward.
No, we are. Let me go ahead and pull up the IVR indicator just so we can see how much the implied volatility has decreased since the earnings have announced. Let's see if we get a little visual right here. So there we go. We got the IB crush. So even though we didn't move too much to the upside, at least that vol will be coming in on some of those contracts because that volatility crush was not light on Tesla. It was nothing too crazy either, but we're definitely getting a little bit of that vol crush. So that'll come through tomorrow at least. But yeah, Tesla definitely doing its thing. SPY kind of sitting break even on this one. Extreme volatility in the market right now. I know yesterday SPY was looking pretty. You know, I mean, we were sitting pretty. I was like, you know, if we sell off even more, I got this longer dated SPY position on that expires in 2 months. I'll be good. I mean, we rallied and some since then, since yesterday. So, I mean, just a 24 to 48 hour window in the market, you can miss a whole 500 point range move just by missing 24 hours in the market. So kind of crazy to see that. Silver kind of break even on that one. Excuse me. Silver kind of break even on that one. Kind of following along gold a little bit. You know, I know I'm going to have silver and gold on now when I get that gold position on tomorrow morning. So I look to manage this one. It does need to be managed by the end of the week anyways. So maybe I'd close this one out, redeploy the capital into gold. Just talking out loud here. And then Shopify. This was another risk of the week we put on last week. That insane market rally really helping this one out. As you can see, it's up quite a bit on the day, but the overall position was mostly made up because of the run that we had today. So a little visual on Shopify, going absolutely ham right now. If we get a little, if this one's loaded for us. Now we'll circle back around to it. And then PayPal, we sold an out of the money put spread on PayPal. Need to manage this one within the next few days. Nothing too crazy in PayPal. Let me double check on the earnings. Earnings before the bell, April 29th. So I'm not going to pull a Tesla on this one. I'm going to manage this one, most likely take it off before earnings. And then we got Lyft. Lyft is a quiet one. I know Lyft was a zebra position that we put on last week, which was also risk of the week. And because we're pretty much break even on the trade, I mean, we're up a few bucks, but that kind of just lets us know it is a zebra position, zero extrinsic back ratio. And that underlying has not moved anywhere. It's been really quiet in Lyft. Maybe I hold this one maybe for another week or two, but not too much more time on the contract. So
I think I took 6 lifts this weekend, Errol. I'm trying my best.
Did you really? No, you did not. Did you really?
I think I did.
You actually take Lyft over Uber.
4 to 6. It's always cheaper. Especially in this town. It's insane. It's insane how much cheaper it'll be. I had one. Where was I going? It's kind of irrelevant. But Uber was 25 and Lyft was 13 for the same ride. It's crazy how different it'll be sometimes.
I would just assume there's less Lyft drivers. So I
think that all of them do both. I think is what's going on. I think all of them do both, and you get to choose your ride.
I know a lot of times we see the Okay.
I think they're sitting there double barreling, and whatever is a better offer is what they're jumping on.
Well, I mean, it depends on the vehicle, but sometimes on the dash, I'll see the Uber and the Lyft sign on the dash. Sometimes I'll only see one or the other, but I also will see both of them as well. What do we got over here?
But yeah, I'm doing all I can for your position, man.
I appreciate you definitely pulling your weight on that one. But I bit a little bit of exposure to the crypto market. Again, Bitcoin definitely not proven to be the new standard for gold. Definitely not. Too correlated to the overall equity markets. And then we got a few bucks on the micros today.
Bitcoin is soaring right now, like this candle. I don't know if you've. Well, actually, I guess this is just today. But yeah, Bitcoin ripping. We're at 93K. I see a Bitcoin 100K right around the corner from Kimberly. Yes, I'm agreeing. We're back to
Bitcoin 100,000 right around the corner.
Back to ripping. I mean, it's at 93. But yeah, this is moving. This 1 hour candle is insane on Bitcoin. Is something happening, chat? Is something happening with Bitcoin right now?
You're like looking around. What's going on right now? And are we looking at the same Bitcoin? I see Bitcoin had a little bit of a rally that the last hour. We had a rally this morning, maybe with the overall market as well. But no, Bitcoin definitely going ham, but very correlated to the equity market. So I'm going to be looking to get short some gold. You know, if Bitcoin and the overall market keep rallying, maybe we get a pullback in gold. But other than that, we'll see what we get. Anything else that you put on? Were you able to take off any of those positions today? Or are you letting, most of it ride for the rest of the week?
No, yeah, I'm letting stuff eat. My TNA position that I put on as our risk of the week last week went very red for a little while there, and then today actually has just had some new life breathed into it. I'm at pretty much break even. My two defined risk options positions are both green, and then my shares themselves are still slightly in the red. Or no, not my shares. I got no shares there. My naked call that I actually took as the risk of the week is slightly still in the red with 3 DTE. It is in the money, so not particularly concerned with theta there. But yeah, I in that one, it was a very good day for that today. Small caps did well across the board. But yeah, no, I don't know if I have anything new at all from the last time that we talked. I'm just, like I said, I'm just waiting. It's just hard, you don't want to get directional right now. At least I don't. I respect people that do. So I'm just getting long delta and kind of waiting for things to stabilize out a little bit again. And also it seems, everybody seems to be neglecting that there still is some decision to be made at the end of this 90-day tariff pause, which could do any number of things to the market. So I'm kind of waiting for that too a little bit here, and just gonna let some shares eat. Hopefully get some more of these positions that I bought way at the bottom of the dip to flip green for me. And yeah, just kind of weathering the storm here. Nobody ever went broke holding cash.
What was that position on TNA? I know TNA had a massive rally today. It looks like, I know that probably came back into the green today, but what was that position on there?
The TNA?
Yeah, the TNA.
Well, I have one naked 2250 call that expires the 25th, Friday. 3 days on that one, and then I took two bull call spreads. One expiring July 18th, one expiring October 17th. I needed 30 by October 17th, 25 by July 18th. So that's 90 days and 180 days. Basically, was the idea. It's 87, 178 now.
Okay.
But yeah,
Nice.
gonna let those cook for a little while on the sentiment that small caps always lag behind in recovery. So given that plenty of time to make its move, but also I think that roughly that time frame is when we should at least, well, I don't know. I keep saying we should have certainty by X date. We're never gonna have certainty, are we? I should just give up on hoping. No. So yeah, but that's the situation there. And the two bull call spreads look very good. Those are both firmly green right now. So happy with that.
Let me double check to see what gold is doing after hours. I hope we're not gapping down too much on gold, just because, again, trying to get short here and want to get short near the top, or try to get short near the top a little bit. But we are continuing to sell off a little bit. But I hear over here, Trump saving the day again.
Yeah, I was going to say Trump. It looks like Trump tweeted about this Powell situation now.
Oh, did he? Trump saving the day, I'm not mad about the volatility that we're getting, but saving the day from an issue that he probably created, which reminds me to Elon Musk and Twitter. What are your thoughts on all the bot accounts on X right now, Gus? I know there's a feature to get rid of all the bots in the thread and in the comments. If you are a verified account, then you can actually comment on a verified account's post. I kind of see that as maybe kind of creating an issue and then providing the solution for the issue. But I don't know if you've seen all the bots on Twitter inside of some of the comments, especially popular accounts. I don't know if you got any thoughts on that too, as we look at gold right here.
I certainly have. But honestly, I really haven't been a big time Twitter user until this year, honestly. Twitter has never been a mainstream forward social media for me. So I can't really speak on how it was before. But I will say I notice no more bots on Twitter than I notice on any other social media platform. I think that this is an issue that is just plaguing the industry as a whole. But you go to any Instagram post, like you said, by a large account, and within seconds of that getting posted, there is 20 bots in there promoting their OnlyFans or something else, even maybe a little crazier sometimes. But yeah, I think it's a widespread issue, and it seems so solvable to me. I don't really understand how this continues to be such a prevailing issue. I suppose it's just a constant battle and people always find their workarounds and stuff, but I don't know, maybe require a phone number or something. I mean, there's ways to work around that, but make these people making the bot accounts have to put up some money to make the bot accounts, and it will stop, I think, is sort of the solution that I find there. And if you need phone numbers, you're going to have to pay for that service. So if you just like require a phone number for two-step, I feel like that maybe cuts down on a lot of it. I don't know. I'm not Mark Zuckerberg. I'm not Elon Musk. These are not my problems to worry about. But I think it's everywhere, and it's definitely a problem. I don't like it.
Yeah,
I've come to live with it.
Yeah. Yeah, no, most definitely. I just thought that was, again, I think maybe the verification. I know with the verification, you need to input your ID, some more extra information, then it kind of helps with the bots and things like that. But then again, not everybody's going to have the ID that could be able to be on Twitter. So it's kind of a difficult one. So we'll see how that gets solved. But gold is selling off after hours, and looking at gold, looking at the options chain before the market closed today, I was looking at a zebra. I mean, I could sell a naked call that is at the expected move. So, I mean, I have a couple options. I think it's really going to depend on how much buying power each position takes up. But I don't know if you have something on Victoria's Secret, a specific strategy that you're eyeing, but I was looking at the zebra again, because I may take off the zebra in Lyft, call that one for a scratch potentially, redeploy that capital from PayPal and Lyft, and then use that for the zebra in gold, or selling an out-of-the-money call on gold. I want to put on a little bit more risk. I'm not going to go undefined in this one. I know it's volatile. I know we've seen some crazy moves, but because it was one that I was not looking to get into anyways, and it kind of just happened to be ballooning to the sky, like now I'm a little bit more interested. So maybe a zebra or out-of-the-money call, but those are probably going to be the two that I'm going with once market opens up tomorrow. I hope we can get a little bit of a bounce. I would love to get a better price on some of these options. I know we're selling off after hours, but if we can get a pop tomorrow, that's probably when I'll throw it on. That's what we're looking at.
Yeah, I don't know. I've started to feel that it may be smart to just blindly get long VIX once a week, no matter what. That's sort
you
of...
did, man. You did. Yeah, I'm so surprised you didn't put VIX as risk of the week.
Yeah, I certainly could have. I mean, I certainly could every time. I mean, I wouldn't say it didn't cross my mind, but it's like I don't know that this is necessarily, especially in a macro context of everything we've seen this administration. I don't think that this is going to be the most volatile week by any stretch of the imagination. So, Tesla reporting. I guess I'm happy I didn't. If I thought that Tesla was going to create some volatility, because it seems like it's going to be pretty flat here. It just take another big move up. Am I being silly? But anyway, yeah. And then Victoria's Secret. Yeah, I'm eyeing this. I think I'm going to go bull call spread. June 20th, buy the 13, sell the 15. Give that 60 days to kind of cook. And see what happens. I feel real comfortable selling the 15 and kind of having that as my necessary number there. 15 is basically their all-time low. I think it was 1460, something like that when I was looking, but they just tested that level, firm bounce off of it. I mentioned the 15 to 16 range being historical resistance. I find it hard to believe that, especially if the overall market continues to recover at all, even if we are 1% higher 60 days from now, I find it hard to believe that VS would trend back below 15. So yeah, I'm liking sell the 13 or buy the 13, sell the 15. 140 is or $1.40, 140 notional is what that would cost me. Probably just one of those, and then let that cook for a little while. But I don't know if that's like risky enough to qualify for risk of the week. So if I must take the May 16th, I will. we can have a off air about the rules here, maybe. But
yeah, I mean, either way, I mean, Victoria's Secret has been absolutely beaten down. I didn't recognize. I mean, this is some pretty consistent selling. I mean, from mid-December, Victoria's Secret's been getting absolutely hammered to the downside.
Yeah,
but as
it's ready to go back up.
We do have gold. We'll see about that. I mean, I do like it. It is a cheaper underlying. So selling some naked puts aren't a terrible idea. I mean, right when I see this too, honestly, I think a zebra isn't too bad either. But we'll see what we get. It is a cheaper underlying. I do like trading those cheaper ones. So you guys heard it here first. We got gold. We got Victoria's Secret. We'll look to find a time window tomorrow to throw some of those positions on. Be sure to check out the Follow Trader page. We'll go ahead and throw those up on there. And then we'll come back Thursday and do a little recap and see how the positions have been working out. But anything to add before we hop on out of here today, guys?
Yeah, thanks for being here, everybody. And Victoria's Secret, the ticker is VSCO, but it's not to be confused with Visco, the app. That's two different things.
That's exactly what I thought of right away when I see it on the slides. That's what I thought of immediately.
Yeah, so just be careful out there. That's my words.
Yeah, gold is gapping down. It's selling off right now. We'll see look at the market right now, real quick. Just give me 2 more seconds before we hop on out of here. I don't know what Trump is tweeting right now, but literally look at this. Hold on, 2 more seconds. What is going on? Why is the market ripping to the Tesla got to be ripping to the upside right now?
I guess, yeah, it probably is. I mean, it was already moving up.
Give us a quick moment. What is going on? We're up.
Trump said he's
up over
not firing
300
Powell.
points.
What?
Is that what he said? Is that?
Yeah, I am seeing people report that, but holy cow.
What is going on?
Trump said he's not firing
It's
Fed.
over a 300-point move, right? 300 to 400-point move right now in less than a minute. It's like a Tesla. Tesla needs to be screaming to the upside.
Holy cow. I don't know. Yeah, I don't know either. No. Moving down. Hard. What's going on? Did we lose Errol? Did I lose Errol? I don't know what's going on here.
Oh, there we go. But no, I mean, the market's absolutely ripping to the upside, 300 to 400 points in a very short amount of time. Tesla a little bit more stabilized, but we'll see what we get overnight. We'll see how gold performs too, because we're going to be looking to get in there. But massive move right now. Real quick, you said that was because of he just confirmed that he's not going to fire Jerome Powell. Is that it?
My sources chat, but yes.
Okay. I love that. Anything else to add before we get out of here, Gus?
No, if I don't have anything else, we'll get out of Ilya's time here.
All right. Awesome. Well, thanks for taking the time to hang out with us on Risk of the Week. We'll see how some of these positions play out, and we'll do a recap on Thursday. That's going to be it. Stay tuned for more segments coming on next, and we'll catch you guys next time. Peace.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
I'm AJ Rudolph. I'm a senior product manager here at Tasty Trade, and I just qualified for the World Poker Tour $5 million free roll in Las Vegas on Friday. So I've been playing poker for about 20 years, actually. I started just with friends. It was like 2005, I think it was, where everybody was like, yes, let's go play poker. There was a huge boom around poker. And I actually feel like that is coming back around again. Right now, there seems to be a lot of interest, and the fields are growing, and everybody wants to get in there, and everybody has a chance to win. That's kind of the cool thing about all of these big events. I feel really privileged that I have the opportunity to go and do this. This particular tournament is only 2,000 people. You cannot buy your way into it. You have to win in order to win your seat, and that's what I did. And so I just buckled in and played my game and really focused and won my seat. I'm a very aggressive player. I do rely very heavily on reading the players at the table. I think that's super important. To be a balanced player, you want to make sure you're doing the math, you're reading the people, and you're doing all of those things in combination with each other, so that way you're using all the tools that are available to you.
People are always asking, where can they find my podcast? There it is, son. Look at that. Option Trades Today. You can listen here. And everybody's waiting for my podcast tomorrow. Option Trades Today, every Tuesday and Thursday around noon. If you want to learn, sir, every Tuesdays and Thursday, Option Trades Today. You can find me on YouTube or wherever you find your podcast. Option Trades Today. You listening to me? Option Trades Today comes out every day around noon, every Tuesday and Thursday. You too can stick with the bet.
Are you tired of one-size-fits-all financial services? Tasty Trade is a bespoke brokerage that tailors to the unique needs of your trading style and account size. You can trade stocks, options, futures options, and crypto all on the same platform. Find stocks that fit your criteria and analyze them with studies and drawings on our charts, or keep up on a company's events and performance with our in-platform newsfeed and fundamental data. No matter where you are, you can trade with confidence on Tasty Trade. Place trades and keep track of the markets with ease on our desktop, web browser, mobile, and tablet platforms. Having any trouble? Don't worry. We have the tools and resources to help. Check out the Tasty Trade Help Center to learn about our platform, trading concepts, strategies, and more. Forget the one-size-fits-all financial services and go with the bespoke broker that can help you grow. Learn more at tastytrade.com.
Oh, yeah, it's Tuesday, April 22nd, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, a little podcast, a little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world. And good God, do we get some incentives to chew on today. More on that in just a moment. But before we get there, let's say what's up to our honorary, our special, our luminary, our dignified guest for today, Mr. Ilya Spivak. Ilya, how you doing, my friend?
After that intro, I'm feeling that much better. It's good. It's a good day. It's a good day, and it's besides being a beautiful day in San Francisco, it's a really, really interesting day in markets, which of course we'll get to here, and it's a day of some relief for me because I always get nervous when my positions start to work, and today I unwound some, and so I feel that much lighter hearted.
Always seem to be on the right side, Ilya, my friend. You never like to take a day of pain or something like that in pursuit of markets moving in your direction a little bit later?
Well, I mean, I've been sitting on this dollar short for weeks, and today I think was time to take some of it off.
Right on. Before we get started, my good friend, we should probably say what's up to the people. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. If you don't already have both, make things easier on yourself and go get them, because there's only one place that you can participate in the chat. Bing, in the middle of your screen. Did we get it? Did we get it? Did we get it? And that's on Tasty Live's YouTube channel. So head on over there, subscribe to the channel, and then start banging your phalanges, your metacarpals, and even your skull into that keyboard so that random-ass characters show up on the screen, appropriate or inappropriate. The point is to spoof the Google algorithm into putting us in front of as many people as possible, changing the world one view at a time. Shout out to everybody that is already in the chat. I would shout you out, but we got the big brain with us, so we got to pay attention. Ilya Spivak, my friend, at Day of Relief, as you mentioned before, had sort of a few days ago put out this idea that he said, who's looking forward to the day when we float the trial balloon trade deal out there to the marketplace for them to chew on, only for it to get walked back by one or both sides a little bit later. I think we're in the middle of that. But my point was, you're going to get a look at what the market's playbook is under that potential scenario. You're going to get a look at what shorts get covered. You're going to get a look at what longs, what sectors, industries, and particular instruments get capital. You're going to get a look at what they want to do on the short end and the long end of treasuries. You're going to get a look at what they want to do with Bitcoin and with gold, with silver. And I think some part of that playbook, the potential for a trade deal scenario, some part of that playbook, I think, was we saw a little bit of a tell today. I'll just open it up for you, man. What do you think is the ultimate catalyst? I think it's obvious, but what do you think the ultimate catalyst for price, and what did you think about price action specifically today?
Well, let's just take a little look back to what you and I were talking about with Tom for the first call at the start of the week. And we had an ugly open, and what I was talking about was being generally bearish, but not yet exposed to the NASDAQ or the S&P, just in the Russell, which had been a little bit soggier on the short side, and basically saying that, look, we have this open, but it's really, really thin markets. And when liquidity comes back once the Easter Monday holiday is over for the rest of the world, pretty much. I mean, the U.S. was open on Monday, Japan was open, China was open, but a lot of the big, heavy-duty markets outside of those were closed for the extra holiday. And so once that liquidity came back, that you'd get some kind of reshuffling of the deck, some kind of opportunistic dip buying maybe, and that what this would do for me is I would look for that as an opportunity to sell into. And that's exactly what I did. So today I used this bounce, which seemed to follow with some of the news flow. We, of course, get the real bombshell after hours, and we'll get to it in just a second. That was a catalyst for me to reshuffle my U.S. dollar exposure. But even sort of before that, where there seemed to be this news out there that Besant is out there saying, look, we're going to have a trade deal with China. Obviously, the current situation is untenable. It's basically an embargo in both directions. And of course, that's what we've been saying here. I've been saying elsewhere. Chris has been saying. All of us have kind of been repeating this idea that once you get to tariffs of 125, 145%, they might as well be tariffs of a bazillion percent. The numbers don't matter at that point. There is no commerce that makes sense there. So you sort of go through the motions of filling the orders that already exist, but the pathway you're on is untenable. And so the leak here of what the Treasury Secretary was apparently saying to a group of private investors was, look, we're going to have a deal because nobody is in a position for there not to be a deal. We've sort of forced the issue. And ostensibly, that was the reason. Okay, I can buy that. Sure, fine. Does that change any of the, I think, reality for why the markets were upset with all of this to begin with? No. Because the markets, again, were not upset with the concept of tariffs, or they'd be selling off in November at the latest. They were upset with the level of concern that they saw in business and consumer confidence data that started to show up around mid-February, and the flow of economic data since then has continued to darken. So that's really the issue for markets here. It isn't so much that there is tariffs or there's not. It's there's a cyclical risk. There's a recession on the horizon. And to add to it, from the beginning of April, there is the surge in uncertainty about the U.S. fiscal stance and sort of the durability of whatever people had become used to, because the term structure has changed. The premium on duration in U.S. Treasury bonds has surged. And not only is it high in absolute terms now, it is the biggest contributor to overall yields since May of 2021. So markets are looking at this and saying there is tons of term premium and duration risk compensation in U.S. bonds. So none of that is changed by any of this. Some of it may be changed by this next announcement that we just saw, which is that the president never intended to fire Jerome Powell outside of the normal sort of sequence of when Powell's expiration date as chair is. And I think that is a more meaningful piece of news that we haven't seen really fully realize yet. Obviously, the futures have gapped higher here as we've reopened futures markets. That makes sense. I think ultimately this resolves to stocks being lower, to the dollar being lower, even though here it's bouncing and probably has a little bit more bounce in it, but to the bonds having durably bottomed.
Okay, let's unpack some of that stuff. So
that was a lot.
It was great. Let's unpack it. Let's start with the bonds. So I thought yesterday, if we saw progress, and I said this on the show, if we saw meaningful progress on any of these trade deals or just with volatility in the market, what you would likely see is a flattener. If the worse the negotiations go, the more pain the market is going to expect in the economy. Therefore, the more ointment the market is going to expect or price in from either fiscal or monetary authorities. Therefore, the higher I thought the long end would go in terms of yield, and the lower the short end would go. So, in other words, the worse negotiations go, the more word I'm looking for, destabilization that's created, the steeper the yield curve is going to go. And the flip side would be true. If you got a walk back, or if you got meaningful deals or meaningful progress or more stability or predictability, a clear articulation of what the goal was here, then you would see the opposite. And at least from the open 17 minutes ago, you're finally getting a little bit of that. The first taste of this, which is the long end up 20 ticks, it's flirting between a half point and 20 ticks, and that short end is starting to lift a little bit, which is what I would expect. I would expect flattener out of this. The question is, how much of a flattener are we going to see here? Is it material in some way, given the two announcements that we just heard? Does the market believe what they just heard? I think the stock market is going to use any excuse to rally, especially when you got a bunch of stocks with 30 to 35% short interest. It is not going to surprise me in any way, shape, or form. You get a bunch of sick short covering, and then people sort of the buy the dippers pile on there, and you get an upside reflexive rally. That doesn't surprise me. But I'm curious how the bond market reacts here, and how strong do we see a flattener tomorrow? And then also, this is part two where I want to go next, which is gold. I think if the market believes what they heard today, I think there's a very real potential, and you already saw a sick intraday reversal in gold off that 3,500 number, that you see a day two continuation of that downside move in gold. Let's stick with bonds for just a second. Your thoughts on my read, which is we should see a flattener out of this if the bond market believes what they just heard with any conviction, the two pieces of information that you just delivered. Your thoughts on that?
I think that it is not quite as obvious to me, but I think that could be the way that this plays out, because there's basically there's two things here. The first thing, and they sort of interplay against each other, and we'll see how this resolves. I certainly think that interest rates have room to go down here, but that they have room to go down across the curve. And where they ultimately go down more, at the front end or at the long end, that I think still depends. And so it's one thing to say, I think bonds are going higher and interest rates are going lower, and the whole curve is going to reflect that. It's another thing to say, well, this will be a steepener or a flattener because of what I think is going on. So the first thing is what I was saying before, this increased demand for duration risk compensation. That because of all of this uncertainty around the fiscal policy, really since the beginning of April is where the market started to really worry about it to that extent. Before then, by the way, since the beginning of the year, the trend was weaker dollar, weaker stocks, they sort of topped in December and then idled and kind of started to catch up lower by mid-February once the data turned, as we said. But really the trend since the beginning of the year was for the bonds to go higher against that sort of environment until the beginning of April. Something snaps, as we can very clearly see here. And what snaps is uncertainty risk and demand for more duration compensation. That's what accounts for this. But when you look at the disaggregated U.S. yield and see what is driving it higher, the break-even inflation rate is actually falling. So the markets don't actually expect the current episode to be inflationary. To our point some weeks ago, they expect the tariffs to be disinflationary because whatever hit they amount to for demand overwhelms the one-off adjustment to any sort of sales tax increase on imports, essentially. So you get then this vast uncertainty that shows up in the long end, which maybe now can start to unclench. Because there is no intent to fire the Fed chair. There's been some level of repeated intervention, like, for example, with the 90-day reprieve on reciprocal tariffs above 10%, right around this level for the bond market. This is the last time we spiked it down here and there was an intervention. We've come back here again. There was an intervention. So there does seem to be a sort of Trump foot, sort of, in the bond market. So, okay, maybe the term premium can start to unclench and the uncertainty around fiscal policy can start to ease. That helps bonds go up. It also helps that the president has said, I am not going to try to bully the Fed into action, but for talking about it. And that, I think, is another big deal because, of course, if the Fed feels like it's being coerced, it is reluctant to want to look like it's kowtowing, even though it's been talking about rate cuts since before this administration came into office. It wants to cut. It's been forecasting cuts. This is not news. But when the president comes out and goes, you better do it, and you better do it now, it's terrible optics for the credibility of the central bank to then look like you've just fallen into line. You want to look like you're making the decision independently. And so that the president has walked back or at least clarified, look, I'm not looking to fire Powell when I say in a Truth Social post that his termination date can't come soon enough. I don't mean extrajudicially. I mean on the time frame as it presents itself. Well, then maybe that can give the Fed actually more clearance to cut. And sooner, if the data demands it. So we have, I think, a bottom in the bonds that's starting to take shape for all sorts of reasons, but that's sort of the core of my argument for why I am long now.
I don't know that I personally would call a bottom in bonds here. I do think, though, that there's this probably a window of time where the U.S. administration has just changed their style of play at the card table.
Yeah.
So they were being an aggressive and loose player. They're now playing a little bit tighter with a little bit more friendly table manner. And I think that could mark a change in sentiment, to your point, maybe a change in premium on the long end. I do think in the very short term, we see a flattening of the yield curve, the 210 yield curve. I think probably the 530s is probably where we'll see it the most. I think I will be very, very interested to know what China's response is to Bessent's commentary, to Trump's commentary, clearly softening his position here, not only to China, but to the world. And so the question number one is, how does China respond? Do they sort of signal a changing in rhetoric? And to me, that will sort of be the cementing of a potential around long end yields, and maybe a little bit of interest in continued flattening. But then the second part is, okay, it's all well and good that we've now entered perhaps this time frame, whether that's 1 day, 1 week, 1 month, or longer, that the rhetoric has softened. That's great. To your earlier point, the realities of tariffs being live in China and postponement of tariffs that are supposed to go live on the rest of the world here.
No, they've gone live, just not above 10%.
That hasn't changed. Yeah. And so I could see a world, Ilya, where yields fall a bit. The U.S. administration doesn't get the progress that it wants, becomes a bit impatient, and flips the strategy from the tight player with the very jovial table manner back to the aggressive and loose
that
player
could be
who's shitting on everybody at the table. And so I wouldn't put that change of strategy out of the cards for a few weeks into the future or a month into the future. And for that reason, I'd be a little bit hesitant to call tops and bottoms anywhere in any assets. But I would say there's a window of time that could be supportive of the long end of the curve, to your point.
Yes. And so to kind of make sure I answer the question about sort of the shape of the curve, the steepening versus flattening. If you think that the news flow here and the sort of the friendlier table manner, the clarification, if you want to call it that, on Powell's sort of status, that what this does is, to some extent, it reduces duration risk in the long end, so yields come in. Okay, that's a flattener. It doesn't necessarily change anything about whether the Fed is going to move rates up or down in the near term, so maybe it keeps the front end relatively anchored. Okay. At the same time, if you also get this news taking some of the term premium out of the front end, where there is less of it, of course, because it is a function of duration, the more duration, the more the uplift there. But more importantly, it sets the stage for Powell to look better and have better optics to cut sooner if the data demands it, and the data might demand it. The expectations, for example, for the PMIs that are coming out tomorrow are abysmal. So if you get the catalyst and the rhetoric ahead of the May Fed meeting starts to sound more dovish, well, then you start to price that into the front end. And that comes in and works against the reduction, however temporary, of the uncertainty uplift at the longer end. And so there is a give and a take and a sequencing here, where it seems like both the front end and the long end are going to resolve to lower rates, but which one moves faster becomes a function of whether the markets care more about the economic data as it informs the Fed outlook part of the equation, versus are we still moving in the direction of a more coherent poker player than we thought we had before. And you can probably sort of answer the question of, is this a steepening or a flattening, by asking, well, when? So nearer term, it's probably, like most immediately, it's probably a flattener. As the data starts to come in, if it continues to look as dour as it has, maybe that starts to change. And of course, if then there is more uncertainty because it turns out the poker player has become frustrated, annoyed, and is lashing out again, well, then it really starts to steepen again. So it's probably a question of where do you want to take that snapshot in time? 2 weeks, maybe 6 weeks, or maybe like a month and a half or two.
The chat is jumping here. If you know, my guess, and this is just dumb numbers, but we're at 65 basis points, the 2s, 10s. If this news today has any real staying power in the market and not an opportunity to just fade short-term sentiment swings and optimism, if it has any staying power here, and you get China that cooperates overnight with their rhetoric and cooling off of rhetoric, I think the 65 basis points, who knows, maybe that could turn into 45 basis points. And you've already seen, I think, what was it yesterday? It was bona fide effectively 4 cuts priced in. You've already seen that walk back a little bit by the implied curve here today.
Yeah.
If I'm not mistaken. Let's go to gold here, man, because this to me was the most interesting trade. And I was a little early. I think maybe 4 days ago, I put on a little mini short in gold. It wasn't really big, not enough to really talk about, but it had been going against me. And last night, it was my last night, gold was at 3,500, and I had that feeling in the bottom of my stomach again when I wanted to puke the position. This isn't the greatest risk management, but I had decent stops. But 35 was something that the way we got there, the speed with which we got there, just gave me that feeling. And instead of puking it, I increased the position size a bit and maybe just got a little bit lucky that we saw this pretty nasty reversal here, down 2.5%, 84 points. What would you do here with gold? Because you're sort of this momentum. You're a type of technical momentum trader. Is this something that you want to jump on the short side of?
It's not something I want to jump on the short side of right here. I think it's gotten into an area of technical inflection. So you can see that it's basically sitting around the place where it kind of consolidated for a while mid-April, let's call it from sort of the 16th through the 20th. There's a kind of area of chop here, and we've kind of landed right on it. For me, this pullback is ultimately going to resolve into a buying opportunity because I think the trend is up. I love that there has been a pullback. I think the structural advance ultimately continues, and I would rather be a buyer whenever it sort of decides to find that it's reached a point of exhaustion and is ready to come back up, rather than be a tactical seller, unless, of course, the opportunity is so attractive from a risk-reward perspective. Kind of like when I bought stocks for a day, when they looked just ridiculous, but they'd stopped falling even though the news flow hadn't gotten any better. And so I just started selling premium, and that ended up being a lucky stroke because that was the day that the reciprocal tariffs above 10% were put on they were put on hold the next day, essentially. And so there was this massive surge. I obviously didn't have any inside knowledge of that, or could have. All I knew was the news flow wasn't better, and that Monday things weren't continuing to sell. And there was a major kind of technical barrier. So I thought, hey, lots of premium here. Let's sell some and see. And got lucky. I got out that same day into the close because it didn't look like the news was going to have sticking power, and it didn't. So for me, unless I see something bonkers like that in gold, which I think you picked up on very successfully, and Chris was talking earlier today how he not only got out of his gold long position today, he actually flipped short, which is an inspired move now in hindsight. Unless I see something, and I didn't see it this time, but unless I see something that just looks risk reward incredible, I am more inclined to be a buyer when whatever downswing exhausts. That's sort of my core idea.
Yeah, I am. So I'm short and I'm holding, and so from the high, we've already had what I would consider, effectively a death candle, 150 point down day.
Yeah,
we've already had something more than that on an intraday swing. But I don't know. I'm playing with house money, and I do think I'm going to let this one ride a little bit. I think a lot has got put into gold in a very short period of time in a really parabolic way, and I think we could very easily see it with a confirmation that comes out of China. If they do not escalate their rhetoric, if they de-escalate their rhetoric, I think you've got to take a lot of premium out of gold on what just transpired. The rhetoric shift in the U.S. market and a rhetoric shift in China is a completely different signal to the market, and you have to take out premium and gold. In my personal opinion,
I agree.
I'm gonna stay short here for another couple hundred points if I can squeeze it out. We'll see.
By the way, this and the long end going down in yields and up in price is, to me, the same trade.
Correct.
So I am quite happy participating in it, being long bonds. At this point, I'm long because I have a carryover call vertical, and I've sold puts, a put vertical last week. So managing my costs down that way and just dialing up long exposure from around these levels, basically looking for the bonds to come up. For me, that sort of compression of the duration risk of term premium in the bonds and a pullback in gold is identically the same idea.
I think it's similar and all related. I think so as well. Yeah. Let's go to the Powell. Let's go to the Powell story.
Yes.
A little bit. Let's unpack that one. So you've laid that out for us at the beginning of the show. Let's go back and unpack this one a little bit.
Sure.
Even though he's walked back that commentary, I saw a lot of commentary that went like this. President Trump cannot legally fire Jerome Powell. I saw a lot of that commentary. And I thought to myself, I go, you're missing the point. That's not the point. If you've got a situation where the U.S. president is just giving hell to the Fed Reserve chairman, that's not going to be a great look for the U.S. in general. That's not going to be a great look. It's happened in the past. Presidents have made scapegoats. They've made sort of whipping dogs out of the Federal Reserve chairman. It's not like it's completely uncommon, but it's not a great look, one. And number two, even if he can't legally fire him, it doesn't mean that the attempt is completely put out of the probability distribution. In other words, Ilya, if I don't have the legal right to fire you, but I attempt, and I say publicly, I say you're fired, or I say you should step down, I've created a bunch of political pressure, which means every presser that you stand up, every Q&A, every interview that you do, people are going to be asking you, are you going to step down? The president's asking you to step down. The president's That's so much political pressure from now until May 2026 to deal with and to try to resist. That's one. And then two, if the attempt is made and has to go to court, locked up in court, you've got a situation where the Federal Reserve Chairman is fighting to keep his job in court. And what that means for risk premium, what that means for the
you thought term premium went up now.
So my only point was to the people who said he can't legally do this and that, the third. I'm like, okay, but I think you're poo-pooing a whole set of risks that are live and they're in the distribution curve, and you have to respect that set of risks. You can't just go,
I agree.
And I think
you're absolutely right.
I think some part of that's true. Your reaction to that, and then what do you think this cooling of rhetoric towards Jerome Powell, do you think this sets their relationship for the next year? Do you think there's a possibility that it ratchets up again and we start talking about Trump firing Powell? Or do you think Bessent or somebody got in his ear and he's going to lay that to bed? He might ride him, but he's not going to flirt with the idea of firing him for the next 12 months. What do you think?
I think that it's very, very important not to get stuck in the rhetoric and look at the financial sort of bottom line. And that's why I keep talking about the term premium. You don't need to have an opinion on whether you think the president's policies, their implementation, their moves are right or wrong. As a trader, in fact, you probably shouldn't be getting those opinions mixed up into how you allocate risk. It's much better to just look at and say what the markets think and let them tell you how to think about asset allocation separately from politics. And I think, first of all, I think you're absolutely right in your assessment. And I think a lot of the people that start foaming at the mouth going, he can't do this legally, or yes, he can, either side, it doesn't matter. A lot of times they're speaking from a political perspective.
Mm-hmm.
And I would encourage people that are allocating capital and managing risk out here to stop doing those two activities at the same time. Stop managing your political perspective as it evolves with events and your trading perspective at the same time. They're different things. Don't let your political bias get into how you manage money. So, for me, it's very simple. It sort of follows what you're saying. Maybe he can legally fire him or he can't. Obviously, the thing is, there is the precedent and the legal structure as it sort of exists. He can't. There's this Humphreys executor thing that's in front of the Supreme Court because he's already fired a bunch of people that ostensibly he couldn't, but maybe he could. It's being debated. We'll see how the court rules. If the court rules in a way that he can, well, then maybe he can with Powell to some extent. Okay, maybe. You have to entertain also the possibility that the president doesn't much care, that he's going to take the action that he's going to take and then say, well, if you don't like it, sue me, and then we'll go to court and we'll hash it out, and you'll present your arguments and I'll present mine. And that creates a whole ton of uncertainty, and again, builds more risk premium into interest rates. And what the president seems to want consistently, and in fact, the reason he's ostensibly berating Powell, is he wants lower interest rates. Well, what has happened as a consequence of the way that he's delivered his policy? Higher interest rates. And the reason that they're higher isn't because the economy is booming as a consequence of the policies. It's because uncertainty is off the charts, as reflected in more term premium in U.S. bonds. You can see it. It's right there. It ticks every day. So you look at it and you go, right, okay, the president is not going to get the result he wants by doing it this way because rates are actually going the wrong way relative to what he wants as a consequence of all of this. He needs to realize that in trying to badger Powell, he's driving rates up, not down, and he's making the Fed more defensive about cutting, not less. He's not going to get what he wants. If he wants lower rates, he's got to go the other way. And this is really sort of the essence of how I look at it. I don't get stuck in will he, won't he. That's impossible to know, especially with this administration where things get walked back. There's a push in this way. Oh, that didn't work. Okay, let's back up. Okay, now let's test the waters this way. Oh, no, that didn't work. Let's back up. Okay, now let's test the waters that way. Oh, that didn't work. Let's back up. It's a kind of iterative approach, if you want to be generous, about policy making, and the markets don't like it because there's not enough forecastability in it. But if you start to go, oh, well, the president can't do it because it's not legal, well, this administration's response to such criticisms has been, well, legal according to who? We have lawyers. Also, we will take things to the Supreme Court. Be it immigration, or be it Powell, or be it some of the Doge stuff, whatever. It makes much more sense to look at the bottom line of what the markets are showing you and going, what is this policy doing relative to what the president wants? If it's not working, he's going to change it. And it's obviously going the wrong way. So he's changing it.
To this point, I was really curious. I don't think this really matters one way or another as to how you view price, but I think it's a window into people's perspective. Do you think Trump caved today? Is that how you would characterize?
No.
The message that came out of the White House?
No, I don't think he caved at all. I don't think he didn't cave.
How would you characterize it?
I don't think he caved or didn't cave. I think he signaled very loudly that what he wants is lower rates. I think he saw that the way he did it gave him higher rates and said, wait, no, other way. But I think the consistent thing is that he wants lower rates. I think he still wants them. I think he just saw that yelling at Powell on Truth Social is not the way to lower rates. It's the way to higher rates.
You know, the thing that I was thinking about all last night is, and I need to find better ways to spend my time. But the thing that I was thinking about tonight is, I go, Trump thinks the long end's going to fall if Powell cuts. And the reason that kept playing in my mind is because I kind of had a feeling that the opposite was true.
It could be. Once the cuts actually start, it could be.
Yeah, I have kind of a feeling that the best case scenario for the long end is that the long end sort of sits still. And that might be totally wrong, but that's why I'm not really taking a bunch of bets in the long end as others are. And if there's money to be made there, I'm just not going to make it, and I'm okay with that. I'm not going to lose any, but other than opportunity cost, but I'm not going to make any. But the thing that kept me, I was like ruminating over this, Ilya. He thinks if Powell drops rates, it's going to lower the long end. He must, because he wouldn't be bullying, he wouldn't be angling for this, he wouldn't be positioning for it so aggressively, so publicly, unless he felt that. Because obviously, higher long end yields goes against everything he's trying to accomplish, I think. And that kept. Do you have the same read that Trump obviously believes that if Powell lowers the short end, you're not going to get a replay of last September? He clearly believes he's going to get cheaper 10 and 30-year paper.
I don't think he is totally wrong on that idea in one set of scenarios, but I think he's totally wrong on in another set of scenarios that I can absolutely envision, and it's what you're describing. I think the long end is one of the great mysteries here. Because on the one hand, you could say, okay, if Powell cuts, and the rate cut cycle, well, first of all, let's just say Powell was going to cut before this administration won in November. That was in the Fed outlook. After they won, that was in the Fed outlook. And now it's still in the Fed outlook. The March update didn't change from December's. So Fed's looking to cut. Has been looking to cut. There's no controversy there. It's completely disconnected from the political cycle. it's been a fact of Fed forecasting forever now, that the Fed is looking to be cutting this year and next year. This much we've known for a long time. The question is how much and when and to what extent. Whether that is going to be more dovish than the current Fed baseline, which is 50 basis points this year, 50 basis points next year. As it stands, the markets are a little bit more immediate in their thinking. They think that 75 basis points are coming this year, 25 basis points next year. So same kind of total tally, slightly more urgency in the market's view. So as I look at this and you go, okay, well, so let's say there is more urgency and the Fed cuts, and it cuts more now up front because the economic headwinds are gathering, and obviously they're worried about inflation expectations, but the bond market is screaming at them that inflation expectations are going down and not up. So ostensibly they have the clearance. They can go. They just need a piece of data to hang it on and say, see, we're justified. We're not being kowtowed. This is real. And once they get a solid piece of data, they can go. And once they get a bunch of survey data that starts to accumulate a pile that tells you, be confident the hard data is coming, you're going to start to see it in the rhetoric, maybe as soon as this week. So, okay, they cut. That shifts the entire curve. To some extent, it also is a little bit of a steepener because more cuts are validated up front. So that means you need less of them downwind. So, okay, maybe there's a little bit of a steepening something there, though, given where the markets are positioned, a bunch of that is probably already there. The markets are already at a more urgent setting than Fed forecasts. So that maybe gives you yields are lower everywhere, but maybe they fall more at the front end than the long end. But then if at the same time, in the Fed starting to do that, you get more of a relief valve on the conflict between the president and the Fed, more of a relief valve on the cost of credit as all of this COVID money comes due for 5-year rollover this year and next, and you get that relief sooner. More of a cheap money cushion for everything as this new policy direction is being absorbed. Then more uncertainty risk comes out of the long end. And those rates do come down once the cuts start because everybody's collective fears unclench a bit with the promise of cheaper money. Sort of like in a crisis when the Fed comes out at the beginning of COVID and goes, unlimited QE. Nobody's waiting for that money to show up in the real economy. They're saying, oh, well, the Fed says unlimited QE. Everybody be cool. Sentiment is fine. Dial it back. Dial the fear back. So if you start to actually stimulate, maybe the uncertainty comes out of the long end to some extent. So the president is not necessarily wrong in sort of those kinds of assumptions. But or that there continues to be erratic reversals, tough negotiations, call it what you want to call it, to quote one Alvin Joyner, then you get into a situation that does a deep cut right there. You might still get that uncertainty in the long end. And it may not come down just because the Fed is cutting. In fact, it may possibly, depending on the speed with which the Fed is moving versus the severity of the recession, it may actually come up in the wrong direction. Because uncertainty is magnified, because the market still feels uneasy that the Fed isn't doing enough, and the fiscal policy side is not any more clear cut. So it could go either way here. What I think you're hitting on that is absolutely correct is that the president might think there is an automatic thing here where the Fed cuts and every interest rate goes down. And it's not necessarily going to be that at all. It could be some of that, but it doesn't have to be.
Exactly. Let's transition because the after hours market, the after hours rally is absolutely insane right now. It's so sick. We're up to 54.10. The Nasdaq's up to 18.7. So basically, what's so funny about what's going on right now is
it's not holding.
I know
it's just a gap.
It's not holding. I'm not following.
Take a look at what the Nasdaq is doing here. You'll see that it's had a massive gap.
Yeah.
But that you're not making further progress from the gap. You're basically hovering. So take a look at like an hourly chart. You've leveled up, but you're holding. You're not really going anywhere.
I agree, but But what I'm saying is we're already 2% higher. So I think what happens is you get this announcement on Powell, this sort of removal of some uncertainty. You know there's going to be a risk appetite when the regular hours opens tomorrow. So all of that gets eaten up today. Whatever that sort of like that free money optimism is, that gets eaten up right now while futures are open, so that when we get everyone else gets open 8:30 tomorrow for cash buying. Now it's a hard decision.
Yeah.
Get what I'm saying? Because they've already taken out all of that sort of that discount, and that appears to be what's happening right now. So my question to you is at 18.7 Nasdaq, 5,400 in the E-mini S&P. We are now getting back to what was a previous area of failure for the S&P 500, right around 5,500. This was a previous sort of swing area or value area. We're now getting back there. And so as optimistic as I think one would want to be, you have to make a call. Do you think we break through 5,500 en route to finding newer high, or the next level, which will probably be 56, 5,800, something like this? Or do you think 5,500 is probably the extent of the damage to the upside? How would you play this, Ilya? Would you start firing against this or fading this the closer we get to 5,500? Or do you think there's enough momentum potential in the market to get past that 5,500 level that we failed a few days ago?
I fired against it earlier today while the cash session was still open, because I was looking at the bounce as ultimately corrective, because I don't think that what it amounted to was anything that changed the bottom line. And the bottom line, I think, for stocks, and I've been harping on this, and I will continue to harp on it because I think it's a critical distinction. Stocks sold off in February and not in November. What stocks are afraid of is recession. They are not afraid of tariffs as a conceptual construct. They are afraid that what is happening is getting consumers and businesses into a defensive crouch, and what this will mean is recession. I think that's the key here. You can have a trade deal with China look more closely. That's for us, people who look at markets every day. That doesn't factor in for the real economy as far as recession implications. That's just more uncertainty into the stew. The 90-day reprieve on reciprocal tariffs, let's extend it by another 90 days, or another. Average U.S. tariffs were 2%, they went up to 10%. They're up fivefold. That's going to be an economic hit. I don't care what happens in these bilateral negotiations, unless the president decides to say, here's my Men in Black memory erasing pen. Everybody look into it. We're going to go to before Liberation Day and the foam board I showed you all. But obviously we can't do that. So what we're looking at here is, any way you slice it, a huge hit to global commerce, which is going to be recessionary almost any way you look at it. Deep, not deep, follow on credit consequences or not, who knows? What we know is that the bond market is screaming that a recession is coming if we look at baked-in inflation expectations. And I don't mean recession like Enber is definitely going to call it. It's going to meet the formal definition, whatever. Some sort of deep economic downturn is currently what the bond market is yelling about, if we look at the baked-in inflation expectations. So I think when you look at then what stocks do with this bounce, I am looking for this bounce to fail. And I'm looking for it to fail because it doesn't change that recessionary on-ramp one bit. But it does improve sentiment. And so for me, that is a reflection of a bond market that starts bottoming, not a stock market that starts bottoming. The implications for the stock market, where the concern is cyclical, remain exactly the same. So just like the reciprocal tariff reprieve, such that it was, failed after a day, so too will this. I don't think they're any different. But the bond market may have some term premium come out of it. Yields might come in. We might see a bit of a move there. The dollar, to that extent, might also have a little run of recovery, and so I've actually taken off a bunch of those shorts, especially against currencies like the euro, the yen, the pound, so not high beta, not high risk currencies, because I think the Aussie and the Canadian dollar are very tellingly not falling apart here, because clearly the response is risk on, and I'm happy to participate on that side and have that mitigate some of what might be some pain being short stocks a little early. But I think ultimately the stocks move fails.
I think you're right, but I don't want to get short 5,500. I for some reason, I think the market's going to have some confidence here in maybe a higher low that's been established, about 4,900 or 4,832 level that's held, 52, which seemed to have some buying pressure or a bid in the market. I think getting back to 5,500, who knows, maybe we trade sideways. I'm not so sure that this thing's just going to flip around. You know, could we see a 1% down day in a day or so, 1.5%? Could we see a little bit of the air come out? I think that's definitely possible. I don't know if we're down retesting the lows anytime soon. Again, the giant caveat being, I think the bond market has got to show you that they believe in what's just been said. And in my personal opinion, that means short end yields will come up slightly, long end yields will come down slightly. The 2s, 10s will come from 65 basis points down in some meaningful way to, let's call it 45 basis points. I think gold's got to come in much more than where it is right now. And I think if those things can happen, I think this isn't just an immediate, the market's going to puke right into this. I think it might be a little bit choppy sideways. If not, we could.
I can see that.
500.
I mean, it certainly wouldn't be the first time that I was way too early and my timing was off, and this is why I'm using verticals that are risk defined, because this is obviously a very this is all very much like playing chess on a liquid surface where the board is changing all the time, not only in terms of its slope and skew and shape and the position of the pieces within all of it, and doing it much faster than usual. Let's say over the past 10 years, maybe. So I'm looking at this and saying, okay, fine. We're going to take these shots because the trend is down. We're testing its upside bounds. The path of least resistance is lower until shown otherwise. But if we got back to, let's say, 5,600, 5,650, and we ran into a wall there, or we got back up to 5,800, 5,900, and ran into a wall there, I mean, these are all very possible things. So I would just take my L, get out, next trade. The scenario you're painting is completely plausible in my mind. I don't weigh it as likelier than the alternative for now. That could change in less than 24 hours.
Agreed, 100%. The tough part is vol's so expensive. It's really hard to take cheap bets, so you really just got to sell vol here. I guess really quickly, I want to go over sort of my view, asset by asset. I'm going to do it fast, and then I want to give you time to really sort of do the same and talk through give a quick summary, a nice little like bookend here. Sure. I am long risk, equity risk. I have a sort of some short NASDAQ futures over the top to slightly lower my delta. And I did that at a decent enough price that it is still very, very profitable. So I'm playing with house money. I chose not to monetize the hedge, so I chose not to close it out. Today, even though I kind of wanted to, I'm holding that a little bit of drag in the portfolio. So I'm not max long. I am flat the yield curve as of right now, but I will be putting on the flattener. I might have missed my opportunity, but I do like the flattener here. I'm short gold. I do think the market is going to have to respect the commentary out of the U.S. administration. If I had to guess, I think we get some neutral comments out of China. I don't know that they massively soften the rhetoric, but it would be great. And if so, I think gold dumps even more. My best expectation, though, is for sort of neutral commentary out of China. And I ultimately think for this 90-day period, Ilya, what I think is most likely is that the U.S. administration is going to announce some in-principle deals with other countries outside of China. I don't see us making material progress with China, regardless of what the rhetoric is. I don't see us making material. And for that reason, I think there's the possibility or likelihood that 6 weeks from now, we're talking about escalating rhetoric, not de-escalating rhetoric. We shall see. That's my view of the world. What's your view of the world, Ilya?
It's very, very similar. I think for me, there are basically two parallel streams here. There is the steady march toward an economic downturn, and then there is the daily ups and downs of the rhetoric and the market's jumpiness around it. So I think from a sentiment perspective, there is an unclenching that probably has some room to occur here. And I think that resolves as lower gold. I think it resolves as a dollar that attempts to mark some kind of a rebound. We're already seeing it move significantly against especially the kind of liquidity defensive alternatives like the euro and the pound and the yen. I've covered all of those shorts. It's been a crazy run, frankly. And it's good to take that off the board. So I've taken those off. I think that unclenching also gives you a higher bond at the long end because some of the term premium comes out and the markets kind of exhale a little. And I don't think any of that changes the march toward recession or some sort of an economic downturn of substance. Whether you want to call it a recession, I don't really care. but some sort of economic weakness at a significant level, and that what this is ultimately bad for earnings, bad for equities as a reflection of earnings, bad for cyclical commodities as a reflection of growth, bad for the dollar because the Fed is going to have to cut rates, bad for pretty much anything tied to the business cycle. And so for me, what this has translated into is I've taken profits on a bunch of dollar shorts, but not all of them, because I think the Aussie and the Canadian dollar are holding up better because there is this unclenching. I am expecting the unclenching to help the bonds. I'm long those, and I think rate cuts will help the bonds more in the speculative run-up to them. Once I think the cuts start, the long end may have topped out and may start to go the other way to sort of what you're describing. But for now, I'm long the long end. I am short at this point the Russell, the NASDAQ, and the S&P. I've been short the Russell for a while now. I've been short the NASDAQ and the S&P as of today, because I think we're in a down move. We're testing its upward bound, and the march toward recession is the operative catalyst. So I'm also short crude oil for the same reason. As of yesterday, I think it's had its bounce and is now ready to move to trade on cyclical deceleration. So I'm short oil, I'm long bonds, and I am less short the dollar than I was, waiting to put it back on, because I think the structural direction of the dollar is lower, probably for a period of years now. And that's something that I want to put back on in greater size, but clearly the euro could have some room to pull back here. The pound could have some room to pull back. The yen could have some room to pull back. So I'm happy to take that off and put it back on later.
So then, in the spirit of you trading the contras of today, what would you do with things like European equities? If some of the world's equities get a little bit cheaper, because for one reason or another, you've sort of been seeing a normalization, sort of capital flight from the U.S. I don't want to be too hyperbolic, but I'm just trying to shorthand this. Capital flight from the U.S. and some risk capital finding new homes overseas. If what we find ourselves in is this pocket where that goes back in the other direction, U.S. finds some new risk capital, international markets, which have been massive beneficiaries over the last couple of weeks, if that trade reverts in some way, VGK didn't necessarily today, but if we did see reversion of that trade, would you be a buyer of cheaper international equities here?
If it's Europe, then yes, but it would have to be a lot cheaper, because I think there's sort of gradients to doing this, right? I mean, obviously, I have been taking the currencies approach and saying there's a capital rotation out of dollars into other currencies, and the currencies that have benefited the most are those that are independent, or at least more insulated from the business cycle. The euro, the yen. The underperformers have been the ones that are sensitive to the business cycle. The Aussie, Canadian dollar. Because the markets don't think the business cycle is going in a positive direction. Hence the stock sell-off. So I think if you do have a downturn in the U.S. business cycle, and I've been talking about this since last year, since early last year, that the only game in town for global growth has been the U.S. service sector for a long time. China is anemic, which has got their GDP numbers. They're still in economy-wide deflation now for an 8th consecutive quarter. This is absolutely awful what's going on there. The PMI numbers that we're likely to get out of Europe in less than 24 hours are going to look like standstill again. If you take the expectations as any kind of a guide. You cannot lose the U.S. economy in this environment. That's been the case since early last year. And you're losing it because it also is starting to turn lower. So in that environment, I don't want to be long international risk in equities that is in cyclical risk any more than cyclical risk anywhere, because the story is of global recession. So the way to trade that is with currencies, in my mind, before that cash becomes cyclical equity risk. But we are looking at a big defense build out in Europe next year. We are seeing the markets start to flirt with the idea that maybe the ECB is going to have to hike, not cut next year. That's starting to show up in ESTR interest rate futures a little bit here. So if there is a sizable pullback in European equities around whatever recession everybody's afraid of, as that starts to really materialize in broader markets, and a fall in European equities alongside a fall in U.S. equities would be very telling of that, because they have been outperforming around this rotation. If things start going correlation 1 down, the place I would be looking to bargain hunt would be in Europe, around this extra defense money coming in and creating a level of activity, and all of a sudden Europe starting to get a kind of gateway drug to fiscal mutualization through defense, and saying, maybe we can have some fiscal federalism here when the time is right and when the norms are ripe to be broken. Europe always breaks the norms when it's expedient for the defense. This has been the case since its conception. In fact, its conception was a breaking of the norms for the sake of defense. The only reason we have a euro or a European Union is because France wanted to ensure that Germany stops coming across the border every so often and mowing down everything after the 2 world wars. That's why the first EU communities were coal and steel, military industry, atomic energy, military industry, and a customs union, capacity for military industry. So this has been about defense forever. The European Union never made economic sense in the classic sense because the economies are too different. Never mind a single currency. They can't all live in a single central bank. We've seen this friction appear over and over and over and over again. And yet, they admitted Greece and Portugal and Spain. Why? Because it made defense sense to get them on the right side of the Cold War after their dictatorships and lock them up on side. And we'll figure out the consequences later. Fast forward to 2010, 2011, there you go. Europe always makes the defense necessary adjustment to economic quality of policy making in favor of defense and not economic coherence, and decides it'll figure out economic coherence later. And all of it always resolves to deeper union, because if anybody knows their history and the bloodshed there, it's the Europeans. They're not trying to go back to the 100 Years' War. So for me, if you're going to bargain hunt after whatever correlation 1 crash may or may not be coming, if that comes and then you bargain hunt, it's in Europe first and then in the US. But for now, I think the currency's way of doing it and then stopping at the cash level before you get global growth risk, that's probably the way I prefer doing it, versus looking to say, oh, well, this is just rotation even in the stocks realm. I'm not sure that's going to be true for very much longer.
I'm setting up a question for Bitcoin.
Disclaimer received.
I have a question for Bitcoin, and it's the angle of the question I want to take is divergent monetary policy. So with the exception of the United States, how would you characterize the rest of the world's central banks and their current monetary policy? Would you call it neutral, restrictive? Would you say that on balance they're easing? How would you characterize the rest of the world relative to the United States monetary policy right now?
I would say the direction of travel up to this point has been much more dovish than the United States. A lot of those central banks have been into cuts for a while. I mean, Canada, ECB, Bank of England. I would say the direction of travel has been they have been a lot more dovish. I think what we're seeing now is a flip. I think what we're seeing now is the U.S. is starting to get to a place where it's going to need to start cutting much more aggressively than it's cut up to this point. I think a lot of the analog cutting has already happened for the Bank of England, has already happened for the ECB. I think, again, this defense build-out next year will probably help cement that and push yield differentials further against the U.S. dollar. Because in the sequencing game, we're starting to get to a place where a lot of central banks have already done the cuts, and the U.S. is behind the curve. So, for me, I think the position of other global central banks is less dovish looking ahead, let's say, 6 months than it's been, and because they're getting to the end of their cycle, and really less dovish when you compare it to what the U.S. is about to do, which is to become much more dovish as this year continues.
So in that context, and again, maybe the why doesn't really matter. I've been building a trading position, not just the long. You buy dollar cost averaging, but a trading position on Bitcoin. And
that makes sense.
And I think there's been this, there's been a breakdown in correlation, in my personal opinion. I don't know how you see it, but I think we've been talking to this idea over the last couple of weeks, and you got an interesting breakout to the upside.
Yeah.
I wonder how does Ilya Spivak think about that, the risk sentiment being expressed in Bitcoin right now, given the backdrop of the conversation we just had?
Yeah, I mean, I think Bitcoin found itself in an interesting sort of state of affairs since the beginning of the year, because it was behaving with risk, because risk started to come off, bonds started to kind of reflect a risk-off sort of vibe, and Bitcoin was coming off. And then when the dollar's sort of screaming sell-off really got crazy, and the bonds started to come down at the same time, and it became an exodus from all things USD denominated at the beginning of April, the correlations in Bitcoin started to break down. And I think that makes sense, because I think what it reflects then is the sort of overpowering of the risk-off narrative by the short dollar narrative. And Bitcoin, as a foil for the dollar, was able to hold up much better. And I think than just a proxy for risk. I think if you wanted to kind of rank 3 assets in a continuum, you would say dollar, Bitcoin, gold. And you would say sort of the dollar and stocks then create this kind of like gravitational pull where stocks are pulling Bitcoin down, but the dollar is helping it up. In gold, there is no conflict. It's just going up because of what's going on in the dollar. In stocks, there is no conflict. It's just a pure risk-off situation. The conflict is in Bitcoin because it's stuck between these competing forces. And as stocks unclench really today, the pull down from stocks eases, but the dollar side is still there. And so Bitcoin pops up. I wonder where that pendulum turns. Because it might turn again. You might get some relief in the dollar as the term premium in bonds unravels, but the recession on-ramp doesn't change at all, and so you go the other way. If the dollar stops aggressively selling, but stocks continue selling, Bitcoin is going to do something else. But you can't argue with a breakout. The price action's there. So I'm not a buyer for all manner of reasons. But sort of ticker agnostic, the breakout is valid. The bias is higher. But I'm not going to participate. I'm going to look to participate in other assets around what is essentially all one narrative.
Let me ask you this question, and we'll close out the show on this one. Did what we just hear today, does it now refocus the conversation on, or can we now pay attention to the idiosyncratic risk in the market? Can we pay attention to earnings and see them for what they are, the actual fundamentals in the marketplace? Can we pay attention to PMIs? Can we now turn attention to the fundamentals in the marketplace? Or do you still think we're in a headline-driven market with one tweet, with one, waiting on bated breath for a line out of Beijing or a line out of Washington, D.C.? Do we have a market now after today where we can refocus on fundamentals? Or are we still in a high-vol, headline-driven marketplace, in your opinion?
I think we never were in a headline-driven market. And again, I will continue to beat this dead horse until it disintegrates. Macro fundamentals have always mattered. It's why stocks sold off when they did and not earlier. If what mattered was the president going out there and going, tariffs on everyone, we'd have a sell-off in November. What mattered was that it started to impact growth in a verifiable way in the data. So the macro data has always mattered. Those fundamentals have never gone away. They continue to matter. Company by company financials, earnings, those fundamentals, they don't matter. Because where we are, besides the guidance matters. In essence, as a verification on what you hear in the PMIs, what you see in the data, as a sort of vibe construct. Because the story is global recession. It isn't this or that company might be incrementally better positioned for it. We still haven't seen the correlation 1 adjustment. It's coming. So far, it's been a U.S. incoherence rotation, which is why European markets have done so much better. European equities have held up much, much better. They had a big move down, but then they had a big rebound, not the kind that the U.S. had. The U.S. has been much more anchored. What you're seeing downwind, if there is a global recession, especially if it is made worse by some sort of a credit situation, because it occurs at a time when everybody has to refi their 5-year COVID money, maybe now not at 5 times the incurred interest, but 3 times, still bad, then you haven't had the correlation 1 shakeout yet, where all of the world's market just leveled out. So for me, the fundamentals always mattered, but they were macro fundamentals, not we did a stock split, we reported EPS higher or lower, we did this or that at the corporate level.
My friend, a conversation that I enjoyed. We weren't as spicy as the last couple of weeks. A lot more time to elaborate on ideas, a lot more congeniality. Ilya Spivak, it's always a pleasure. If people want more from you, tell them where they can go, my friend.
As always, I'm all over the PM schedule for the Tasty Live Network. Overtime kicks off with myself and Chris and Dylan Radigan right after a last call, right after the closing bell. Then Macro Money, where I nerd out on all of these things that you and I talk about here once a week with too many charts probably. And Chris and I talk on Futures Power Hour, bookending the week Mondays and Fridays. You and I talk to Tom at the weekly Futures Open on Sundays for First Call. I'm writing for the news and insights portion of tastylive.com. I'm offering pithy commentary, hopefully, at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky and anywhere else that thinks it's not too crazy to put a microphone in front of me. So I'm all over.
If you want to follow me, I'm on Twitter at Victor Jones. The O and Jones is 0 because I like to be difficult. We could go another 45 minutes. There were a list of topics here I didn't get to. Tesla being one. The fairly interesting report, and the more interesting price response on that report. But I'm sure, we've got content starting for everybody again, starting at 1:30 a.m. Central Time. And I'll give my thoughts on Twitter. Ilya, it's always a pleasure, my friend. I look forward to seeing you or speaking to you on Sunday. Everyone out there, hit the like button before you get out of here. I'll be back tomorrow with a conversation with Chris Vecchio. Until then, peace.
Peace.